Usually Tuesdays to Thursdays, usually on Fridays, I mean, buildings are empty. And it's looking bad because this is a situation that's played out for more than 3 years. People have been waiting for it to get better. They thought it was initially just a health scare COVID thing. Clearly, behaviors have changed. Clearly, companies are pivoting. And they're at a time where they had to cut costs. So you have even the biggest tech companies that were driving growth in the market, like Meta, like Amazon, like Microsoft, all pulling back and scaling back or putting their space up for sublease, which adds even more space on the market for landlords to compete with. So it's a bad look for landlords who now have to deal with less income coming in from rents and demand and higher costs from increased borrowing rates, debt costs, and pressure from the lenders.
Yeah, and we heard from Jay Powell yesterday. He said what he always says, that commercial real estate is a concern. To what extent do your sources talk about the potential contagion of the commercial real estate space into our overall economy?
It's a big concern. I mean, you know, like over the past 15 years with near zero interest rates, people have been pouring money into real estate as sort of a safe environment that would yield relatively stable returns, and they could get good debt, good leverage on it. And so you have major banks that have huge amounts of loans out that are backed by these real estate. You have some of the biggest institutions that have giant real estate portfolios. A lot of it was concentrated in offices because that was viewed as relatively stable prior to the pandemic and prior to remote work. And so now you have $1.4 trillion of commercial real estate loans that are set to expire this year and the next.
Wow.
A lot of it is being backed by offices. A lot of it is being backed by expensive debt that people can no longer afford to pay. And some are even just thinking it might not even be worth it to try to negotiate or put in more money into this property. So they're cutting their losses. And that can have rippling effects for property owners, investors, lenders, the major banks, and then cities, you know, retailers, city revenues, taxes.
Talk to us about San Francisco, because that's probably, pound for pound, the hardest hit city, certainly in the United States. How bad is it there?
It's pretty bad there. I mean, the office market is doing the worst in San Francisco. It really saw the major boom that followed from the growth of these tech companies over the past decade. And you've seen that these tech companies really led the remote work environment. And a lot of people living in San Francisco, they have to commute the farthest commutes back to downtown. They're dealing with a crisis in downtown where people are, you know, feel unsafe going into the city. And then you also have a lot of major landlords that are just giving back the keys on office buildings, hotels, and even apartments there because it's all kind of fueled by this tech ecosystem, which is being pulled back.
So even the apartments then, because I always hope, and Eric Adams in New York is pushing for the return to office still, but selfishly I always hope that these buildings can just get converted into apartments overnight so that I can afford an apartment in New York City. But that sounds like that's not gonna happen.
You and everyone else. Yeah, I mean, you know, apartments are a different issue from offices. Obviously, offices are suffering from a complete fundamental, return to work crisis. But apartments are also suffering from the pullback of these companies. And especially in San Francisco, you have a major local landlord that defaulted on a debt portfolio of apartments that were valued at more than $1 billion just 3 years ago. And you're seeing in New York, you know, a lot of people are pitching conversions of offices into apartments. It's just not that easy, right? Even around Midtown Manhattan, a lot of buildings are big floor plates. They're dark in the interior, and it costs a lot of money. Even if everything works out engineering and architecture-wise to convert an office building, it costs a lot of money, and it requires financing, which there is no availability today.
Wow. All right. So, is there, when you talk to the folks in the real estate business, is there any solution? I mean, I'm looking at a chart you have in your story here. We're talking about office availability rate in selected U.S. downtowns. I mean, San Francisco, 32.7% office.
Right.
I mean, it's Houston, 32%, Atlanta, 31%, L.A., 30%. I mean, when you talk to the real estate people, is there any solution here, or do you just wait it out and hope for a turn back? Because it seems like some of the work from home hybrid is here to stay.
Yeah, I mean, I think people have been waiting for 3 years, and some of them have been extending their loans. And I think the environment today that's different from previous crises was that not only are we dealing with this existential crisis of work habits changing, you're also dealing with all the fastest interest rate increases in a long time. And so they really can't extend for that much longer. And so you're starting to have people cut their losses. You have the Blackstones, the Brookfield. These are some of the biggest institutions that are walking away from their portfolios, walking away from hundreds of millions of dollars of investments. And that sets a signal for the rest of the market, right? It sets a signal to say if even the most well-capitalized institutions are just giving up on these nice office buildings that have financial and tech tenants inside them, then how does that fare for the rest of the market? How does that fare for the older buildings that like nobody even wants to be in? And so I think people are, my sources are really waiting for this to unravel over the next maybe 6 to 10 years, just as you're seeing with shopping malls. That's something that evolved more than a decade ago, and it's still evolving. You still have dead zombie malls that are kind of sitting empty. People don't know what to do with them, and they're kind of just limping along until someone's willing to come in and take it for less than dirt value.
Who are the winners then of the downfall of commercial real estate?
I think the winners are people that have a lot of cash on hand, have the flexibility to move, and maybe have the expertise to be able to make some of these investments work. You know, we're talking with some buyers out there. I mean, I did a previous story on New York wealthy buyers that was interested in looking at offices. And you have these family offices, these really wealthy individuals that see a really good opportunity to snatch up offices at a major discount from they wouldn't have been able to access, Yeah.
Have we seen, like I'm just thinking here in New York City, have we seen any major transactions in terms of a building being bought or sold that you could get a sense of, oh boy, the market is off 10%, 30%, 50% from pre-pandemic levels? Do we have a feel for even what the market is now for office space in the city?
That's the biggest question is people don't know where values are at, which is why there's so few transactions. I mean, essentially, if you don't have to sell a building right now, you shouldn't be selling it because people are waiting for big discounts. But one example we have in our story is Wells Fargo recently sold a pretty trophy tower in the middle of downtown San Francisco for $200 per square foot, which is down from the market peak just in 2019, right before the pandemic, of more than $1,000 per square foot.
Okay.
So that's a big discount, right? In New York, you're not necessarily seeing those massive deals yet, but people are waiting for it. I mean, some of the smaller one-off office buildings that we've covered took like maybe a 40% discount from previous prices, maybe $100 million less than a decade ago. But it's not looking great, especially for the older office buildings, especially that aren't getting attention.
Yeah, I agree. I think one of my takeaways from your story is this is going to be a multi-year story playing out over the deterioration in the value of commercial real estate in a lot of major markets. Natalie Wong, she's a real estate reporter for Bloomberg News, joining us here in the Bloomberg Interactive Broker Studio with her big take story, World's Empty Office Buildings Become Debt Time Bomb. You can find those big take stories, and they're absolutely worth the reads across the board at Bloomberg.com/big take. You can go on the Bloomberg Terminal. NI space big take will get you to those stories. We appreciate getting some time from Natalie Wong. Right now, let's get some news here down in Washington, D.C. with Amy Mars.
All right, thank you, Paul. The investigation continues into what happened to the Titanic tourist submersible after crews found pieces of the Titan lying on the ocean floor near the wreckage of the Titanic. Oceanographer and former Navy officer Robert Ballard is credited with first locating the Titanic wreck back in 1985 and tells ABC that the ocean is a challenging place in part because it is so dark down there you can't see anything.
So it's very intimate in that regard, but it's very unforgiving. You can't see pressure.
All 5 people on board were killed when that vessel imploded. Republicans are sounding the alarm about a spike in illegal immigrants from Russia and China. Republican Congressman August Pfluger of Texas says these are not your normal asylum seekers.
I've heard directly from sheriffs in my own district that they apprehended multiple individuals from the PRC who were deemed high-value targets and were taken into custody by the FBI.
Congressman Pfluger warned during a congressional hearing that U.S. adversaries are expanding into Central and South America. He says over a 10-year span, China sold $615 million worth of weapons to Venezuela and that Iran is docking warships in Brazil. A Moscow court has ruled Wall Street Journal reporter Evan Gershkovich must remain in jail on espionage charges at least until late August. The U.S. government declared him to be wrongfully detained and demanded his immediate release. Gershkovich is the first American reporter to be be arrested on espionage charges in Russia since September of 1986. That stretch of I-95 in Philadelphia is set to reopen at noon today. The office of Pennsylvania Governor Josh Shapiro says you'll be able to drive over that road again less than 2 weeks after that fiery gasoline tanker crash destroyed a bridge over an exit ramp. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. I'm Nathan Hager. We are watching stocks and bond yields fall. In fact, equities are headed for their worst week since March, with worries building in this market that central banks are going to have to keep raising rates to tamp down inflation, and the worry that that could lead to sharp economic downturns. In fact, we heard this week from Fed Chair Jay Powell telling Congress, yep, another 1 or 2 rate hikes may be needed, depending on the data. But TD Securities Global Head of FX and Emerging Market Strategy, Mark McCormick, says he actually thinks the Fed's done.
We think macro volatility is going to stabilize. We think the global economy is still late cycle, not recession. And that basically benefits a rotation of capital outside the U.S. So I would say we like sterling lower relative to other currencies. But again, it gets the boost from a weaker dollar, largely because the U.S. inflation impulse being much weaker. We don't see the Fed hiking again.
But this morning, we're seeing dollar strength and stocks fall. We check the markets all day long here at Bloomberg. The S&P right now is down 26 points, or 0.6%. The Dow is down 184 points, a 0.5% decline, and the NASDAQ is down 120 points. That is a drop of 0.9%. The 10-year Treasury is up 16 seconds, yield 3.73%. The 2-year yield 4.74. That is a 101 basis point inversion between 2s and 10s. Oil is headed for its worst weekly drop since early May. NYMEX crude is down 1.6% at $68.41 a barrel. COMEX gold is up 0.6%, or $12.40 at $19.36.10 an ounce. The euro 1.0888 against the dollar. The yen is at 143.62. CarMax shares are up by 9.5% on better than expected earnings and revenue in the latest quarter. And electric vehicle makers are seeing a sell-off. Tesla is down 2.8%. At least 3 brokerages downgraded the stock this week. That's a Bloomberg Business Flash, and Bloomberg Markets continues. Paul Sweeney in Madison Mills.
All right, Nathan Hager, thank you so much. We appreciate it. Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio. One of the big topics so far this year has been AI, artificial intelligence. It seems to be on the tip of the tongue of every CEO out there as a kind of something that'll really impact their business and maybe efficiency, operational efficiency. We want to talk to somebody who's kind of actually in that business. Matt Calkins joins us. He's the CEO and founder of Appian. It is a publicly traded application software company. APPN is the ticker to load into your Bloomberg professional service. The stock is up 46% year to date. It's got a market cap of about $3.5 billion. Matt, thanks so much for joining us here. First of all, tell us what you guys do at Appian. How do you fit into the tech stack?
Yeah, well, it's great to be here. We're a platform for building and running new processes, and we've been selling AI as part of those processes for years to major corporations.
So in particular, so processes, so just, what are the products, what are the services that you guys offer your clients?
Yeah, process is like a workflow. It's a series of logical actions that a corporation does in order to execute its own identity or its relationship with customers. And often that means delegating some of that work to digital workers like AI or business rules or robotic process automation. And Appian ships with a full suite of digital workers, including many different forms of AI.
So talk to me then about what your deals are looking like these days and how that's changed, if at all, since this AI boom began. Are you getting different calls now than you got previously?
This AI boom has been great for us. Let me say that Appian is a scrappy innovator in an industry otherwise dominated by giant tech firms. And so when a change comes along, we know that's our advantage. And so the prominence of AI is a very good thing for us, and it's absolutely getting us a higher profile because we try to be a step ahead. And so we've maybe got some insights into where AI is going, and our customers count on us for that.
So one of the things I think, when people talk about AI in a business context, they think it will lead to efficiencies. Do you see that? And if so, kind of whereabouts?
Absolutely. AI is going to lead to efficiency. It's not going to replace people. It's going to accelerate people. We're all going to become more productive as a result of working side by side with AI. And the main change over the next few years is how we all come to accommodate having AI as a partner in our work. It's going to enable us to do more things, to skip ahead on the dull parts, the repetitive parts, to emphasize the use of our judgment and let the machine do the rest. I think AI is going to be an exceptionally empowering technology, a partner rather than a replacement for workers.
And Matt, just to say apologies to our audience, we've got a little bit of a delay with you on the line with us, but I do want to talk about the clients that you work with a little bit more, because you advertise an 8-week timeline to fulfill the needs of the clients that come to you. How do you accomplish that within kind of the different industries and different clients that are coming your way? How do you get that speed every time?
Appian differentiates itself by being quick to implement a working and value add product. We've always done that, and it differentiates us because we're focused on the return on investment. In a year like this, return on investment is doubly important. Every company out there is trying to do more with less. And so for us to be able to say that not only can we get you the value of artificial intelligence, we can do it within 8 weeks. We can do it in a short period, and you will see the benefit. You're going to see it before the end of this year, and it'll be paying off by the end of the year. That's a really essential pitch in a moment of economic uncertainty. We've been making that pitch for years and coming through on it, but I think it's never been more important than it is today.
So, Matt, your stock's up 46% year to date. What is the market like?
Well, you know, the market bounces around a lot. I tend not to take it too seriously, to be honest. I don't watch the market. I watch our value add. I watch what we're doing for customers, and I watch whether we're making investments that are going to pay big benefits in the next year or the year after that. A lot of what we're doing today, the customers we're serving, the features we're writing, you won't see that in the stock price for better or worse for a long time. So I try not to get too caught up in it.
Okay, fair enough, but you got to look at it a little bit here, to be fair, right? And you know, I'm sure that you, among many others of your peers, have benefited from this AI rally. What would you say to the skeptics that say, hey, you got to look at the fundamentals, don't get too excited about this AI rally, don't just go in on any company that mentions the word AI in their description?
Oh yeah, there's a lot of hype around AI. You're right about that. But there's also going to be substance. There'll be real value, and you'll see it this year. There'll be case studies publicly. I mean, that's the next wave in the AI storyline. You're going to start seeing a lot of case studies in which organizations are benefiting from using AI. Right now, for example, we're working to take 30% off the time that it takes to run a critical visa process, for example, 30% just by introducing AI. It's extraordinary how much productivity gain we can implement and realize in a short period using AI technology. So yes, it's hype, but it's also substance, and the substance will be clear this year.
Matt, when does your company become profitable?
Well, you know, we stated at our last quarterly announcement that it was our expectation that we would break the even barrier next year and that we would be profitable in 2025. And that is my intention today.
All right, Matt, thanks so much for joining us. Really appreciate getting a little bit of your time. Matt Calkins, CEO and founder of Appian. It is a publicly traded company on NASDAQ. APPN is the ticker to load into your Bloomberg terminal. Again, it's up about 46% year to date. And looking at artificial intelligence, which Matty is just, it seems like every company in the S&P 500 in the last quarterly conference calls mentioned AI multiple times.
Which is so funny. Like, I don't really need Kroger to be mentioning AI eight times on their earnings call, but you know, if it's going to benefit them, then good for them. I have questions.
Yep.
I don't know.
All right, Appian Corp. It is a 3.5 billion market cap company, APPN. We appreciate getting some of the time from Matt Calkins, CEO and founder there. S&P 500 right here, folks. It is off about 0.6%. NASDAQ off about 0.9%. So a little bit of a heavy weight to the tape here on a Friday afternoon. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, you might have to go somewhere else for your morning Java. Starbucks baristas at more than 150 stores plan to strike over the next week in support of LGBTQ workers. Starbucks United says the walkout will involve more than 3,000 employees. The move comes after the union's allegations that store employees across the U.S. were told to remove LGBTQ-themed decorations. The coffee chain in an email says the union's claims are not accurate. 3M agrees to pay billions of dollars to settle claims related to the use of so-called forever chemicals. Bloomberg's Abigail Doolittle reports.
This company has a lot of litigation hanging over it, so this one piece is now being resolved. We reported earlier this month that they had agreed to pay, in theory, $10 billion to resolve this situation with PFAS, the chemicals used in the foams that help put out fires. Now we are hearing that they are agreeing to pay between $10.5 billion to $12.5 billion. Ultimately, the amount will have to do with how much PFAS are found in water supplies that have not been checked. These basically are municipalities that have been suing the company, and successfully at this point.
Thank you, Abigail. The chemicals known as PFAS don't break down and can seep into soil, water, and the human body. The NFL has scheduled a special owners meeting for July 20th. That's for an expected ratification vote on a sale of more than $6 billion for the Washington Commanders, going from Daniel Snyder to a group led by Josh Harris. The league sent a memo to team owners last night notifying them of the meeting for consideration of the deal and a potential approval vote. That's according to sources in the league talking to Bloomberg. And those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio looking at these markets here. A little bit of a weight to the tape. S&P 500 off 0.7%. NASDAQ off 1% there. WTI crude oil, I want to call that out, off about 1.3%. Now it's $68.57 per barrel WTI crude there. Yields a little bit pulling back here. The 10-year Treasury off 5 basis points, 3.74% on your 10-year Treasury. Right now, let's head down to Washington, D.C. We're going to get world and national news with Amy Morris.
Thank you, Paul. It was a red carpet welcome for India's Prime Minister. Narendra Modi met with President Biden at the White House yesterday, followed by an address before Congress. President Biden and Prime Minister Modi announced a series of defense and commercial deals designed to improve military and economic ties between their nations during yesterday's state visit at the White House. And later, Modi made a rare address to a joint meeting of Congress where he stressed the importance of democracy.
The beauty of democracy is the constant connect with the people, to listen to them.
At least 70 lawmakers called on President Biden to address human rights violations in India. Modi, though, was met with applause on Capitol Hill. The evening ended with a state dinner at the White House. Republican moderates may be wavering on the GOP's abortion agenda. Centrists in the House Republican Conference are trying to sort of reshape the planks in their party's platform. They're trying to ensure that the Republican Party's longstanding goal of restricting abortion access doesn't interfere with their other priorities or turn into a losing message in the 2024 election cycle. Empty office buildings all over the country and the world have become a debt time bomb. From San Francisco to Hong Kong, higher interest rates and falling property values are bringing commercial real estate market to a perilous precipice. Owners of office towers in New York and London just walking away from their debt rather than spending money to lure more tenants. And the landlords of downtown San Francisco's largest mall have abandoned it. A new Hong Kong skyscraper is only a quarter leased. Analysts predict the trouble with commercial real estate will add stress to a financial system that is already dealing with the regional bank crisis. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Madison.
All right, Amy Morris, thank you so much. We appreciate it. All right, so Madison, I guess if you work at Citi, you're supposed to be there 3 days a week, like a lot of companies. But I guess some folks are just kind of like, 2 days, 3 days, 1 day. But Citi's going to start cracking down on that, aren't they?
Yeah, it sounds like from our amazing reporters here at Bloomberg, they have some sources that have told them that according to Citi officials, the vast majority of staffers are following the rules for hybrid work, but there are some employees with persistent, unexplained absences. You never want to be described that way in the workplace, Paul.
And it's interesting. You think about some of the investment banks. They were one industry that was pretty adamant about trying to get people back to work. Goldman Sachs, Morgan Stanley, pretty aggressive. Bank of America as well, particularly here in Manhattan. But Citi was one of those that said, no, we're going to stay flexible, number one. Number two, we think that's a competitive advantage because we think we can attract and retain talent by being more flexible than maybe some of our competitors. But I guess what we're hearing from Citi today is, okay, we're still flexible. We're in this hybrid thing. But when we say 3 days, we mean 3 days.
Yeah, I mean, it's a really difficult position for Jane Fraser, the CEO, because she's, been pressured to push for a remote work hybrid environment, which is typically more accommodating to women and other folks within companies. But, this is her saying, guys, if I'm going to throw you a bone, treat it well.
And I'm kind of snobby on this issue when I'm sitting on the train platform on Tuesday, Wednesdays, and Thursdays. It's pretty crowded in the swamps of Jersey as I come into the city. And I say to people, am I going to see you here on Friday?
I mean, it's annoying. It's like going to the gym on New Year's Day. It's like, guys, I've been doing this for a while.
Yeah, but I'll tell you, exactly. I mean, I have 3 offspring that are in the workforce. And my daughter who lives and works in the city, she can't even conceive of working 5 days.
Yeah.
That generation who just recently in the last 3 or 4 years came into the workforce, they just can't even conceive. So I think it's going to be a really, really tough job for corporate America to get folks back. We'll see how it plays out. We'll follow it up. We've got lots of good reporting on that. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to drive the conversation forward here. Madison Mills, Paul Sweeney in the Bloomberg Interactive Broker Studio. We're going to get the latest on these markets with a couple of really smart folks that we have here at Bloomberg, Katie Greifeld and Jess Metton. They cover all the markets for us. And it's Friday, which means we talked to Joe Mysak and we talked municipal bonds. How about that? I'm like, bring Matt Miller into the studio to talk muni bonds. Matt loves the muni space. Plus, we're going to check in with Erica Edelberg. She's a mortgage-backed security strategist with Bloomberg Intelligence. I want to figure out what's going on in the mortgage-backed securities market. We've got, mortgage rates going higher. The Fed starting to, remains very aggressive on the rates. What's that mean for the MBS market? So we're going to check in with Erica on that. But right now, let's go to Charlie Pellet and get a Bloomberg Business Flash.
Hi, thank you very much, Paul Sweeney. We are looking at a down day, on track for a losing week as well. Right now, the S&P down 1.3% on the week. Today, a lot of red on the screen across the board. The Dow, the S&P, NASDAQ 100 index, Russell 2000, they're all trading lower. Right now, we have got the S&P 500 index down 30. That is a drop of just about 0.7%. Dow Industrials down 190, a decline there of 0.6%. NASDAQ down 139, a drop there of just about 1%. NASDAQ 100 index now down 1.1%. Russell 2000 down by 0.8%. Stocks on track for the worst week since March as anxiety rises that central banks will have to ratchet rates higher to tamp down inflation. Certainly the theme this week. 10-year yield now 3.74% with a 2-year 4.76%. Spot gold up $11 the ounce to $19.25, up by about 0.6%. And West Texas Intermediate crude oil continues its slump down another 1.3%, below $69 a barrel, 68.62 right now on WTI. Higher borrowing costs are pummeling the American commercial real estate industry, and with that story, here's Bloomberg's Vinny Del Giudice.
Industry data show the amount of commercial real estate assets in distress is on the rise, hitting roughly $64 billion in the first quarter. That's a 10% increase. Retail properties, including shopping malls, account for half the tally. Office buildings are also struggling given the rise in remote work as well as job cuts. Manhattan was the most active market for distressed commercial real estate assets, followed by Los Angeles and Houston. Vinny Del Giudice, Bloomberg Radio.
From real estate to the auto industry, and CarMax's quarterly earnings soared past Wall Street estimates. Its shares surging now by 10.7%. Rival Carvana down 8.5%. Recapping stocks lower, S&P down 29, down 0.7%. 10-year yield 3.75%. The 2-year 4.76%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio. As Charlie was just reporting, 2-year Treasury note, 4.76%. I'm just going to put my cash there and go sit on the beach the rest of the summer.
I mean,
what do you
why
think about
wouldn't
that
you?
strategy?
That sounds great to me. I mean, as a strategist, I would
Yes.
recommend that.
Okay.
Yes.
All right, let's look at these markets here. We got a little bit of a weight to the tape, as Charlie was just reporting. Let's bring in some really smart people to help us kind of walk through this. Katie Greifeld, Madison Mills. Jess Metton. I'm just all confused. I got co-hosts coming and going all over the place. Jess Metton, Katie Greifeld joining us here in our Bloomberg Interactive Broker Studio. Katie, what are you looking at here on this Friday trading?
I mean, I'm looking at the plunge in bond yields. Holy
Yep.
moly. I know we got some weak data out of Europe, but to see it follow through into U.S. Treasuries is pretty interesting. Let me pull up the 2-year right now where we are. Pretty steep move lower. Well, it's only 2 basis points or so, but at one point I know you had the 5-year Treasury yield down about 10 basis points. So interesting to see that trying to time when, the market fears tip from inflation fears to growth fears, when that becomes sort of the main focus of central bankers will be interesting, but pretty dramatic.
It feels
move.
like the discussion just today was a little bit more recession-y. This concerted central bank movement we've seen over the last couple of weeks, is that pushing this global economy maybe more towards a recession? That's what it feels like.
Maybe globally, but the U.S., I mean, up until what? Overnight, the message was, okay, the recession calls have been pushed out. No recession this year, blah, blah, blah. And then here we are this morning with this big risk-off move.
So what is that looking like in equities, Jess?
Well, if you look at the S&P 500 on pace to snap 5 consecutive weeks of gains, you're looking at that. It's down more than 1% on a weekly basis. Also taking a look over at the NASDAQ 100, also down about 1.4% for the week. But in context, when you think about this AI-fueled rally, especially over the past month, really fueling these gains, the NASDAQ 100 in particular is still on pace for its best first half to a year ever. So we can see if that holds by the end of the month, which will actually be next Friday. So still a stellar backdrop. Obviously, last year's laggards being this year's leaders. But another point, because we're talking a lot about yields, and I was taking a look at what was happening with the flows data I know Katie takes a close look at this too when it comes to the money market funds and the whole debate about being able to
Did they go down again?
So yes. So if you looked at the Investment Company Institute, their latest flow data, so it decreased by 18 billion in the latest week through Wednesday. So that's 2 consecutive weeks of outflows. So before last week, when we began to see a bit of those outflows, that was the first time in about 2 months since obviously Katie covers this too when it comes to tax day. That was a big flow. But because of those banking stresses and those recessionary concerns, when we think back to March, that's when we saw more investors piling in. But now you see 2 consecutive weeks of those outflows, some of that obviously going toward equities. So we need to see if that can continue to be a trend there when we talk about cash coming off the sidelines.
Katie, what do you make about crypto, Bitcoin above 30,000? I mean, this is a question I usually reserve for Matt Miller, but I mean, you're here, you'll do it.
I mean, we talked a bit about how basically the reason that we were seeing this rally over the past week is due to that BlackRock spot Bitcoin ETF filing that really breathed some life into the space and into the rumor mill as well, that, you know, maybe BlackRock knows something about the SEC's thinking that we don't know. But as I wrote actually in the Bloomberg Crypto newsletter last night.
Crypto newsletter.
Did you guys know that exists? You can
Tell
subscribe.
us how to
I can subscribe. How do I subscribe?
Where do we go?
Okay, I don't know. I think you find it somewhere. There should be a button.
Wait, I gotta figure this out for you. You talk and I'll figure this out.
Okay,
This is
okay.
important
Anyway,
to
it
plug.
comes out Tuesdays and Thursdays. It's a bi-weekly thing. But as I wrote in it, this is a fun situation because we're going to have an answer. When you think about how many times the SEC can delay a decision on this specific ETF, that gives them a maximum of 240 days from, I think it was July 16th that this ETF was filed. So we'll find out soon enough whether something actually has changed or whether, you know, this is BlackRock just hedging their bets.
But it doesn't seem, I mean, when BlackRock talks, again, people listen, going back to the old
Clearly,
E.F. Hutton commercial from back
Yeah,
in the
there's
day.
been at least 4 issuers who have filed for very similar products in the days since that filing. So clearly people are listening.
And there's a demand out there for it. Hey, Jess, I got a stock that's actually up today, and it's our good friends down in Richmond, Virginia, which is where I'm going this afternoon. CarMax,
Yes.
up 10%. People buying cars?
Ticker symbol KMX. So when you look at this stock, obviously, like you said, up today. Also, if you look just this year, it's up more than 40%. So close to 11% on the day. So seeing as how some of these cost cuts have been driving, obviously, these results beat there. And so it did report fiscal first quarter earnings and revenue that did come in above the average analyst estimate. So you have analysts over at Truist. They still have a price target of about $64. If you look right now, obviously trading a bit above that. But obviously this particular, when you're looking at this company emerging from this current cycle, even stronger in this type of position, obviously when you think about what's happening with used vehicle prices. Actually, when I left Texas, I sold my car to CarMax and
Did you?
came up here. This was a long time ago, but
What car did you have?
I had an Xterra. I had a Nissan Xterra.
A Nissan Xterra. Is that kind of like an SUV thing?
Yes,
Richie?
it is. Yeah.
All right, tooling around
Texas.
Corpus Christi, Texas.
College Station.
College Station.
But this was a while ago.
Oh, this is a while
This is
ago.
over a decade ago. But I sold it and then came over.
These are the types of fun facts that make radio magic.
So when I see CarMax, I'm like, oh, that's where I sold it. And then I was like, I don't need a car when I come to New
You
York.
don't need a car in New
Still
York
don't
City.
need
Oh my
one.
gosh.
So true.
You
So
could pay
true.
a second rent to, you know, park it though.
Exactly.
Yeah,
You're
exactly.
missing out on that.
So, Maddie, you don't own a car.
No,
Because you're in the
course
city.
not.
Katie,
I lease a car.
you lease a car.
You lease
Okay.
a car?
Yeah, isn't that
Where do you
nuts?
live again?
I live on the Upper East Side. I'd give you my exact address.
Where do you
but we're
park the
all-
car?
Right.
I park it in a garage, and I pay an arm and a leg to do that. But
And you have a horse.
I have a horse.
That's right. You have to
I
go.
need the car to get,
get
the
to the
makes
horse.
sense. That totally makes sense.
I'm just lighting money on fire every month. It's
No, I
insane.
get it. When you
I
explain
know.
it that way, I get it.
You're all going to go out and see Gus one day. All right, Katie Greifeld, Jess Metton, thanks so much for joining us. Appreciate getting a low down on these markets. Again, the S&P 500 off about 0.7%. Owning a car, leasing a car in the city. Wow.
I mean, I can't imagine it. I feel like that will happen in my next leg of adulthood.
yeah.
You know,
Yeah.
I just got a dog. I don't need a car too.
What kind of dog?
You know, he is a rescue. Thank you for asking.
nice.
Yes, but I think he's like 100% mini poodle.
100% mini poodle.
He's 8
And where
pounds.
Did you get this mutt?
He's a rescue from China.
Really?
I know. Paul, it's a whole long story.
That is
I'll
a
give you
story
the
in and of
details.
itself.
Yeah.
All right, it is Friday, folks, and it is 11:10 a.m. Wall Street time. That means one thing and one thing only. That means we talk municipal bonds, and we do that with the one and only Joe Misek. He's the editor of Bloomberg Brief, covering all the municipal bonds, and he doesn't phone it in. He doesn't mail it in. He's live here in our Bloomberg Interactive Broker studio. Joe, what do we need to know about the municipal bond market? I've got a Federal Reserve that's raising rates once, maybe twice more this year. How's that impacting your market?
Well, supply way down, and the underwriters, the Wall Street banks, are finally reining in their forecasts. Carry story this week, and now they're backing off from their predictions of 400 billion plus, and now it's more like 350, 375. So supply
is a problem.
Municipal issuers generally don't like to jump in when there's a lot of volatility. So right now we're seeing some come in, and if you don't have to, which most of them don't, because as you know, they still have COVID relief funds.
Exactly, the gift that keeps on giving.
Right,
And
you just step aside.
You know how important this discussion is on munis every week? It's so important that it's actually sponsored. And this year, today, the Focus on Munis is brought to you by Build America Mutual. The new deal created American infrastructure that unleashes new opportunity. Today, we're doing it again with massive investment in modernizing our infrastructure, and municipal bonds backed by Build America Mutual help make it happen. Invest in the future of America with BAM insured bonds. Hey, Joe, we've been talking all day about commercial real estate. It was the subject of a big take story yesterday. You look around Midtown Manhattan, not to mention San Francisco, Hong Kong, anywhere you want to go, big city, remote work, that's an issue. It's a thing. It seems to be here to stay. What does that mean? It can't be a good thing for the revenues of cities. How's that being reflected in the municipal bond market?
It's funny. Standard & Poor's came out with a report just the other day, concerning the subject of downtowns, basically saying, well, it might have an impact on their credit down the line. And it was really a very kind of anodyne report, if you will, and actually there was a graphic in it, and it showed that in terms of downtown recoveries, New York, San Jose, Washington, and Phoenix were above the median.
No.
Yes. Now, at the bottom, San Francisco, of course. That's not a surprise to you. Philadelphia, Seattle, Atlanta. And the median was Miami. But New York was actually at the top, with 70%, 75% of downtown coming back. Now, you ask, what is it doing to the municipal bond market? Because we've had so little supply, and because bonds are being called away and maturing. I think the figure is $100 billion for June, July, and August. Municipal bonds are solid. The prices there, you're not going to see a lot of action. So you're not seeing people bail out or things like that. It's just that as S&P says, could be a concern down the line for certain cities.
Let me ask you a question from our Muni Markets newsletter, which says that the most traded issue on Thursday was the Oklahoma Housing Finance Agency revenue bond. What's up with that?
Yeah, just, the most active traded, we put that in there just to give people an indication of what's going on, and it varies day to day. Really, there's almost no rhyme to reason. No,
really?
No rhyme, no reason.
Ever?
No, generally speaking, it is a relatively new issue. So maybe they came last week, or they're trading in the when issued market, and because the thing is with munis. After about 30 days, trading halts. And as Mr. Sweeney knows, the old axiom, all bonds go to heaven.
That's right.
They disappear. Safe deposit boxes, accounts, home,
bottom drawer,
under the mattress.
Yep. All right, Joe, talk to us about the higher education business. Boston University. Here's something, like when I was a kid, it was a good school, but it wasn't like crazy good. But now it's like crazy good. BU has accepted, all right, their acceptance rate has dropped to 14.4%. In 2009, it was 58.5%. What's going on with BU, and why is it in the municipal bond market?
Man, they came to market this week, and they sold. Now, they're rated AA minus, AA3, okay? Good ratings, not AAA, and they sold the 2048. I'm taking a look at the pricing here. 2048 was sold with a 5% coupon. Price to yield 381, 36 basis point spread over AAA. So they trade almost like a AAA. Now, and it's because of the reason you cited: 30% increase in applications. At a time when enrollment, two different things, but enrollment overall nationally down 7%. So what's going on there? There are the haves and the have-nots, and the have schools. Boston U is one of them, and it's probably, one of the selling points is the city of Boston itself, which is a lot of fun.
And it's in the Back Bay by,
right?
It's a great part of town. But it's always been that way. You know what? One thing has changed, because my last of my 4 offspring is going to be a freshman in college this fall. What's different, even from his siblings, is no standardized tests. None of this SAT, ACT garbage, which was a,
I'm like, are you serious?
Which is just a big part of our youth. Everybody, you had
I
the
have
stress
so much
and
PTSD from that.
Exactly.
Like, how do you become an adult without having
so
to
from the
go
pandemic,
through that trauma?
one of the silver linings, I guess, is screw the standardized test.
83% of the schools, I think it is.
Yeah, exactly.
Are test optional.
All right, Joe. Guess what?
That's it?
That's it.
No.
Joe Misek, he covers all the municipal bonds stuff for us. We appreciate getting a few minutes of his time talking municipal bonds. This is Bloomberg. All right, let's get some company news right now with Steve Rappaport.
Good morning. We get reports that Ford is gearing up for another round of layoffs. Let's get more on that from Bloomberg's Andrew O'Day.
Bloomberg has learned that another round of layoffs could be announced as soon as next week as the automaker streamlines operations. Not clear how many jobs are on the line, but sources say the cuts are expected to affect mostly salaried employees on Ford's gas engine side of the business, as well as its electric vehicle and software division.
Thanks, Andrew. Shares of Ford currently down more than 1%. Paul, how dependent are you on those rear view cameras? We were talking about cars earlier. All right. Yeah, all right. Well, Honda is recalling nearly 1.2 million Odyssey minivans and Pilot and Passport SUVs because the rear-view camera image may not appear on the dashboard screen. Honda says in documents posted by U.S. safety regulators, the problem was traced to a faulty coaxial cable connector. Baby shark toys. The themed bath toys are being recalled, millions of them actually, because of concerns that the top fin and on the plastic sharks could cause injury. The Baby Shark and Swim bath toys are made by toy maker Zuru and have been sold at Walmart, Target, and other stores nationwide since at least 2019. And the hacker group Clop claims another victim. PricewaterhouseCoopers and Ernst Young have become the victims of that criminal group by exploiting a flaw in the MoveIt file transfer program. Hackers threatened to post internal data from the professional service firms unless a ransom was paid. Both companies, by the way, say they have stopped using that thing called MoveIt. And the damage, according to both companies, it was minimal based on the hack. And those are the company reports we're following this hour. I'm Steve Rappaport.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long at Bloomberg. We have got the Dow, the S&P, NASDAQ all trading in the red right now. Stocks are on track for the worst week since March as anxiety rose that central banks will have to ratchet rates higher to tamp down inflation. Treasuries led a rally in bonds on bets that excessive tightening will bring on sharp economic downturns. Technology-heavy NASDAQ 100 index did drop as much as 1.5% during the morning session. So right now we've got equity markets lower across the board with the S&P 500 index now down by just about 34 points, a decline of 0.8%. The NASDAQ Composite Index down 155 points. That is a decline of 1.1%. Dow Industrials now lower by 207 points, a decline of 0.6%. So again, recapping here, stocks on track for the worst week since March. The Dow, the S&P, NASDAQ, Russell 2000, NASDAQ 100 Index, all trading lower. Recapping, S&P down 33 now, a drop there of 0.8%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We appreciate that. I don't know if you know this. I recently acquired a palatial compound in the Jersey Shore. Went to the mortgage market, got my mortgage 6 handle. Hurt very hard. But I'm going to refinance this bad boy in like a year with a 4 handle. I'm not too worried about it. But now I'm paying attention to the mortgage-backed securities market because my lender owned my mortgage for like 15 seconds. Oh, wow. And then I got the notice it's some bank on the West Coast, and then I have no idea where it is now. But I pay my mortgage every month, so it's a good MBS. So let's talk about the mortgage-backed securities market. Erica Edelberg, she does this for a living. She's made a career out of it somehow. People do that stuff. Erica Edelberg, MBS strategist, Bloomberg Intelligence. She joins us live here in our Bloomberg Interactive Broker Studio because she's a player. She doesn't phone it in. She doesn't mail it in. She comes into the studio. Erica, what's your market looking like with rising interest rates, with a Federal Reserve that's talking about 1, maybe 2 more hikes this year? What's that do to your market?
Very interesting environment right now for the mortgage market because as high as mortgage rates seem to the homeowner, mortgage yields on secondary mortgages are actually below Fed funds right now.
Why would that be?
Well, for one thing, unlike you, unfortunately, most people did take out mortgages in 2020 and 2021. Yep. And so they have coupons, closer to 2 to 4%, that 4 being the high end. And while, prices do adjust to that, at the same time, in theory, there's a lot less risk to investors in that lower coupon stuff because it's and nobody's going to prepay. It's basically it's a known quantity at this point. So the yields are actually around 470 or something for the 477, I think, for the mortgage index as a whole, which is really skewed towards those lower coupons. And then you have, SOFR at 505, you have Fed funds up around 525. Really interesting time. So it means you're actually earning less yield on your mortgage-backed security for most people than you are, for most investors, than you are in the funding market. And the other interesting fact, mortgages trade kind of current month, forward month. It's an interesting technical market. Mortgages actually are more expensive in forward months now because effectively you're in contango. Your storage costs are high for mortgages right now, which is a really unusual situation.
So how does a potential Fed hike in July impact that?
Well, it depends on what goes on with mortgage spreads and mortgage yields, but it could put even more negative carry into the mortgage market, from an investment standpoint. Right now we're at 525 upper bound. If we're at 575 upper bound, depending on how much mortgage yields go up in tandem, which, right now with the curve inversion, what's happening is the long end is actually staying fairly pinned and the short end is going up a lot. So as a result, it could make it even more negative carry for some investors to hold mortgage-backed securities.
So do institutional investors even pick up your phone call, Erica? I mean, do they want to talk to you about the mortgage-backed securities market, or is this just something, I've got other places I can go?
Well, we had our mortgage agency summit this week with a lot of institutional investors, and
so people showed up.
It was sold out.
Really? Okay.
Yeah,
So
standing room only.
Nice. Wow. All right. Yeah. So what were some of the big topics there?
Some of the big topics were concerns around bank regulations because what that's going to do in terms of whether or not some people feel like increased bank regulations could actually help mortgage-backed securities because they may have to own more liquid assets. But at the same time, and mortgages are considered liquid, there's a question mark about what really should be considered liquid now. Because SVB Bank, for instance, the problem was, mortgage-backed securities are liquid, but you don't want to sell them when they're at 80 cents on the dollar, and you're going to take a 20-point loss, besides which they held them in their held-to-maturity accounts. So, a lot of discussions about whether or not the banks can get back involved, and that's really one of the reasons that mortgages have widened as much as they have. But in general, a lot of discussion also just about how wide mortgage spreads have gotten. At 190 basis points for the current coupon in the end of May, that was the widest we've been since the financial crisis. So a lot of institutional investors, including a lot of our panelists, really felt like that was a great time to buy. We've tightened 25 basis points, 30 basis points since then. Maybe time for some people to reassess where we are now relative to risks. But, general consensus that spreads in general offer a lot of value for AAA assets.
Is that spread an indication of an upcoming recession, or is it the opposite?
No, I think it's an indication of a few risks. One is the debt ceiling, and that's one of the reasons, the fiasco, that's one of the reasons that spreads did come in as much as they did. Another risk is the possibility of a recession. But on the flip side, I think there's, kind of consensus among a lot of investors, fixed income investors, that corporate spreads would do worse. But, from my perspective, as I wrote in my outlook this week, I think it also just makes volatility probably rises a little bit. And mortgages are very sensitive to volatility because they have a lot of interest rate risk.
All right. The big take story out of Bloomberg News today, world's empty office buildings become debt time bomb. A tipping point is coming. In the U.S. alone, about $1.4 trillion of commercial real estate loans are due this year and next. That's according to the Mortgage Bankers Association. What's that mean for your business?
I mean, I tend to focus a little more on residential mortgage-backed securities, but at the same time, I think that means that well, let me take one step back. Fed Powell, God, I am old. Fed Powell mentioned this week that he thinks housing prices have maybe put in a bottom.
Okay.
And there are a lot of indications that in residential mortgages, we may be averting a real housing recession. Another note, actually, article on Bloomberg today. But, while residential mortgages and mortgage market may not bring down the economy this time, I think there's a lot of risks in the commercial real estate sector. It's ironic because one of the things that has helped the housing market is that a lot of people are working from home. The opposite for commercial real estate and office buildings in particular.
Would you agree with Powell that we've already had the bottom?
Bottom might be an overstatement. I think we never expected prices to fall dramatically. There's a lot of seasonality to prices. But it does seem like there's a lot of demand for homes, even at these mortgage rates, even given the affordability concerns.
Yeah.
I think new home prices may not have hit a bottom, but the sales are doing great, and they had a lot of margin there. Existing home prices, there is so little inventory. So I think if you just look on a year-over-year basis, we may not be that far from the worst year-over-year numbers that we've seen, maybe another couple %. But it does seem like nobody's going to have to walk away from their homes, especially the people with 2% mortgages, as long as they're employed. So barring a big recession, which I think isn't most people's base case, where a lot of people lose jobs, I don't think the housing market itself is at risk, and such small inventories available is going to keep housing markets fairly firm.
All right, a year from now, where am I going to refinance my mortgage?
A year from now, see, I only think it's 6 months increments.
All right, 6 months?
Yeah, I don't think you're going to see a 4% mortgage rate. IRA is calling for the
That would be Ira Jersey, Bloomberg
Ira
interest rate
Jersey,
strategist.
Yeah, brilliant guy. He's calling for end of year 10-year rates right now at about 3%. Let's say we add 150 basis points onto that. You add about 300 basis points for primary rates. That's the thing. So 150 basis points to secondary, and then another 150 basis points between where lenders get. So that puts us still close to 5.5–6% mortgages at the end of the year.
Yikes.
But on the other hand, he also says one of the things that we agree on is that basically the Fed is being very cautious about raising rates further at this point. But if we do begin to see a recession, I think they'd prefer to have, if we're close to 2% inflation, I think they'd prefer to have Fed funds quite a bit lower. So escalator up, elevator down.
Right. But the housing market's still pretty, is it strong? What is the status of the housing market today? I mean,
housing sales are very weak in existing
very
homes.
Weak. Okay, existing homes. Because nobody's selling, right?
Nobody's selling.
Okay.
That's the thing. So it's the supply-demand imbalance that's still pretty out of whack because there's still just not enough supply even for the amount of demand. Demand is diminished, but there's not enough supply. New home builders are jumping into that void, and they're actually filling it pretty well. One of the reasons they're able to do that is they're able to buy down the mortgage rate for a lot of investors. So some of these investors aren't paying anything near 6% on the new homes.
Why did I pay 6.5%? 6.5%.
I don't know.
I don't know. I didn't do a very good job there.
Yeah.
I'm not good on that whole debt thing.
Because
I'm much more of an equity
you'll
guy.
and that's the other. For people who can afford it, that's the other part of the equation. Is a lot of people say, and maybe it's not very PC, but they say marry the house, date the rate, because at some point you can probably refi that rate. But if you love the house, don't give up an opportunity. Not everybody's in a position where they can afford to do that.
Right.
But for those that can, that's one of the things that's keeping some segments of the housing market strong.
Yeah, they're not making any more of the New Jersey Shore, so I'm happy where I am. Erica Edelberg, thank you so much for joining us. Erica Edelberg, she is a mortgage-backed security strategist for Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Broker studio. Right now, let's head down to Washington, D.C. We're going to get world and national news with Amy Morris.
All right, thank you, Paul. SpaceX closing out the first half of the year with a Starlink launch. It's happening now. They're at T-minus 2 minutes, 44 seconds until takeoff. Falcon 9 will launch from Cape Canaveral in Florida, carrying 56 Starlink satellites into orbit, the 44th mission of the year. They got 50 more missions set for the second half of 2023. The search for a missing Titanic-bound submersible has become an investigation and a salvage mission that'll take an indefinite amount of time. The Coast Guard says the vessel imploded. It killed all 5 people on board. Oceanographer and former Navy officer Robert Ballard is credited with first locating the Titanic wreck back in 1985, telling ABC that the ocean is a challenging place, in part because it is so dark.
So it's very intimate in that regard, but it's very unforgiving. You can't see pressure.
Underwater drones remain at the site to gather any information after that tragic end to the search for the missing sub. Pakistan's interior minister says an estimated 350 Pakistanis were on board an overcrowded fishing boat carrying migrants. That sank off Greece last week, and many remain missing. Many have died in one of the deadliest incidents in the central Mediterranean. An estimated 700 migrants were on that boat when it sank June 14th. Only 104 people were rescued. 82 bodies have been recovered. Republicans are sounding the alarm about a spike in illegal immigrants from Russia and China. Republican Congressman August Pfluger of Texas says these are not your normal asylum seekers.
I've heard directly from sheriffs in my own district that they apprehended multiple individuals from the PRC who were deemed high-value targets and were taken into custody by the FBI.
He warned during a congressional hearing that U.S. adversaries are expanding into Central and South America. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long at Bloomberg. We have got stocks sliding. We are off session lows, but stocks are on track for the worst week since March. Anxiety is rising that central banks will have to ratchet rates higher to tamp down inflation. S&P right now down 29 points, a drop there of 0.7%. We've got the Dow down 174, down 0.5%. Nasdaq down 142 points, lower now by 1%. Treasuries led a rally in bonds on bets that excessive tightening will bring on sharp economic downturns. The 10-year yield 3.73% right now, the 2-year 4.76%. Well, as for the Federal Reserve and the rising interest rate environment, Linda Dissel is senior equity strategist at Federated Hermes.
Fundamentally, actually, the economy is very strong. And what I think people fail to continue to appreciate is still the amount of stimulus, unbelievable outsized stimulus. I just read a statistic that said that liquid assets for consumers are $4.4 trillion greater than what they were at the end of 2019. And we were doing just fine at the end of 2019.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Again, 10-year, 3.73%, with the 2-year, 4.75%. Spot gold now higher by $8 the ounce to $19.22, up by about 0.4%. Crude continues to slip today, down 59 cents, $68.92 a barrel, down by about 0.9%. Nikola suspects foul play after a fire broke out at the electric truck maker's Phoenix headquarters that affected multiple vehicles. Nikola says no one was injured in the blaze and an investigation is underway, but the situation adds to headaches for Nikola, which last week said it would cut 270 jobs to reduce expenses and preserve cash. Shares of Nikola down today by 7.2% among other EV makers. Rivian down 3.7%. Tesla down now by 2.6%. Recapping, stocks are lower with the S&P down 28, drop there of 0.6%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pelleton, thank you so much. We appreciate that. Madison Mills, Paul Sweeney here in the Bloomberg Interactive Brokers studio. Looking at these markets, definitely a weight to the tape here. We had Fed Chairman Jay Powell front and center this week. Madison first at the House Wednesday, then the Senate yesterday. And then I guess if you're going to use one word to characterize his testimony, consistent. I mean, they've been talking about fighting inflation and raising rates and being aggressive, and they certainly have been. And that continues to be the message. The market, not so sure if they're buying off on it, but boy, it's like tough to go against the Fed here. Alfonso Peccatiello joins us. He's the founder of the Macro Compass. Alfonso, thank you so much for joining us here. What did you take away from what we heard from Fed Chairman Jay Powell this week in his testimony?
Well, I think it was relatively clear that the majority of the FOMC committee members want to see higher rates between now and year end. But if you ask me, what the Fed wants right now is relatively irrelevant for market pricing, because the Federal Reserve and other central banks will be able to control the very, very short end of the curve, but the back end of the bond curve is instead rather influenced by other factors. So it's actual growth and actual inflation that matter. And we're getting more evident signs, if you ask me, that nominal growth is trending down. We are in a disinflationary wave that has started slowly but surely a few months ago. It now seems to be even accelerating a bit on the downside. And the PMIs, for instance, released this morning, were another sign that the US economy is weakening under the hood.
So how do you square that, though, with some of the other data, right? I know with the data, it's kind of pick your poison. You can find the data that tells the story you want it to, but we still have seen consumer strength, particularly in the jobs market and with wages as well. So how do you square that with a narrative that we are seeing a slowdown?
Well, I think one of the things that has eluded most analysts has been that the size of the fiscal stimulus the US has done, even if 2 years ago now, has been so large that to work through that stimulus, it sometimes takes quite a lot of time. So monetary and fiscal policy tightening works with lags through the real economy. And we're seeing, let's say, the most sensitive parts of the economy already showing some of the weakness. So the housing market although slightly rebounding, remains still pretty fragile, and that's a highly sensitive sector. But if you move towards the consumer side, so let's say the part of the economy that has received the direct benefits from fiscal stimulus, it is understandable that it's going to take a little bit longer for the lags to reach these sectors. So I think it's just literally a matter of time until we see broader weakness. And even in Europe, just to change a bit the picture, the PMIs today reveal that the manufacturing weakness is slowly but surely spreading to weakness in services. In my opinion, it's just a matter of time and respecting the lags in the macro cycle.
So, Alfonso, does that suggest that you prefer that, or you would suggest that this Fed just wait here and not raise rates further?
Yes, I think the risk management decision here from the Fed should be to wait rather than to keep tightening. If, again, I can move back to other central banks that have been a bit more aggressive with their hawkish stance recently, so take Canada or take the ECB, for instance. Back in July 2008 or in July 2011, the European Central Bank proceeded to hike rates. It hiked rates because they were looking at the wrong set of coincident indicators rather than focusing on leading indicators, and they were worried about certain things. Might it be inflationary pressures or wages or the labor market? They ended up hiking, and then in summer 2008 and later on in 2012, that revealed to be a policy mistake. And I think right now, just from a risk management perspective now, after you have had one of the fastest hiking cycle ever in the United States, it is fair enough for you to wait and take a pause and assess how data comes in. A pause should last minimum 3 months. So this stop and go strategy, I think, is not the correct risk management policy by the Federal Reserve.
So you think July is live or no?
July is live. Doesn't matter what I want. It's up to what the central bank will do, right? I mean, we're all investors here. So one of the things I learned managing money is it doesn't matter what you want. It's what the Federal Reserve will do in the end. So I think we are live, but I also see that jobless claims have finally started to pick up. If you look at continuing claims, we're 8% up from the lows. And generally, when you are 10, 12% up from the lows, you are getting more recessionary signals from the labor market. So I think if you get a couple of weak data, especially when it comes to the labor market, the Fed might reflect once or twice, but it's definitely live.
So, Alfonso, where do you think inflation is likely to settle out? I mean, we hear from the Federal Reserve this 2% number. And quite frankly, I'm not really sure where that came from, why it's so important. But where do you think inflation is likely to kind of settle out here in the next, 1 to 2 years kind of time frame?
Look, I can try and answer the 2% question. I had the opportunity in my previous job to talk to a couple of central bankers and policymakers. And look, the reality is the 2% target really comes from wanting to be as safely enough far away from deflation as possible. I mean, we're in a debt-based system, and deflation is the enemy of a leveraged system, right? But also, you want to have an acceptable and controllable level of inflation. It's pretty arbitrary, but 2% sets you at least reasonably far from the deflationary territory. Will inflation settle at 2%? Look, I think people confuse cycles with trends. And in this disinflationary cycle, as I expect a recession still to hit in the US, every recession has caused inflation to come down pretty viciously. And it will come down, in my opinion, pretty viciously, and not only to 2%, but even below that if you actually get a recession. That is not to be confused with structural inflation drivers. So over a long-term trend, if you look at the deglobalization, if you look at the offshoring change of heart from many CEOs, if you look at the demographics changes, for instance, that are about to come, you might want to make a case that structural inflation will settle maybe at 3 or 4%. That doesn't mean in this cycle, especially if you get a recession, you can't actually get inflation back to 2%. You will get inflation back there if you get a recession.
Yep, got it. Alfonso, thanks so much for joining us. As always, appreciate it. Alfonso Peccatiello, he's the founder of the Macro Compass. He's a good buddy recommendation from Danielle DiMartino Booth, and that's a good one.
There you go.
It was excellent.
Yeah.
And, we love Danielle, so when she has a recommendation for somebody for us to chat with and maybe get a little bit smarter, we will take her up on that. Alfonso Peccatiello, founder of the Macro Compass, joining us here on Bloomberg. This is Bloomberg. All right, let's get some company news here with Mr. Steve Rappaport.
Paul, shares of CarMax are up after the auto retailer beat profit estimates. Let's get more on that from Bloomberg's Simone Foxman.
Earnings per share $1.44 versus estimates of just 80 cents. Used vehicle sales still down 14%, but there was some improvement on costs as well. The concerns about the auto industry still very real. Prices have fallen. There are affordability concerns, tighter lending standards. However, Bloomberg Intelligence says that with more than $2,300 coming in for CarMax per unit, wary buyers may also look to CarMax ahead of Carvana, which has been struggling, and that may be improvement for the company in terms of overall sales.
Thanks, Simone. Last year's World Cup host is making a play for the American sports market. The Gulf nation of Qatar struck a deal to acquire a 5% stake in a company that owns 3 Washington area franchises, including the NBA's Washington Wizards and the NHL's Washington Capitals. The deal would mark the first time that a foreign sovereign fund owns a piece of a major U.S. sports franchise. Any international bid for an NBA team will likely face significant scrutiny and a lengthy vetting process. Qatar's questionable record on human rights could come up as a probable problem. And some of the world's empty office buildings, they're being described as debt time bombs. Higher interest rates, falling property values, those are threatening the commercial real estate market. In New York and London, owners of gleaming office towers are walking away from their debt. While in San Francisco, landlords at the downtown's largest mall may have abandoned it. And in the U.S. alone, $1.4 trillion of commercial real estate loans are due this year and next. Those are the company stories we're following this hour. I'm Steve.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Madison Mills, Paul Sweeney here in the Bloomberg Interactive Broker Studio. Madison, seen a red headline going across the tape. Bitcoin climbs to highest level in a year, $31,280, up, $1,100, 3.8% today. So how about that? I mean, the Bitcoin just kind of ripping. We saw some, a lot more institutional interest in this crypto over the past week. So really interesting to see how this thing is moving. So we'll keep an eye on that. The S&P 500 off 0.6%. Right now, let's head down to Washington, D.C. We're going to get world and national news with Amy Morris.
All right, thank you, Paul. The dangerous heat in Texas continues this week. People are being told to stay inside, but for some professions like roofers, that's just not an option. Danny Bose is with Southwest Metal Roofing in San Antonio and says they put their workers' health front and center because the heat is absolutely dangerous.
You don't work full days or anything like that. You cut out during the hotter parts of the day. Take lots of breaks, drink lots and lots and lots of water.
And the heat is not letting up. Triple-digit temperatures are expected through the end of the month and into July. Investigators are continuing to search for any insight into how a catastrophic implosion killed all 5 passengers aboard the Titan submersible. Officials have yet to conclusively determine whether the devastating implosion occurred last Sunday when the submersible stopped communicating about an hour and a half or hour and 45 minutes into its dive. Fresh off the state dinner with Indian Prime Minister Modi, President Biden now signing an executive order that's set for today that aims to increase access to low-cost contraceptives for Americans. The president is also set to hold an event with abortion rights groups. Republican moderates may be wavering on the GOP's abortion agenda. Centrists in the House Republican Conference trying to reshape the planks in their party's platform, trying to ensure the Republican Party's longstanding goal of restricting abortion access does not interfere with other priorities or turn into a losing message in the 2024 election cycle. And empty office buildings all over the country and the world have become a debt time bomb. From San Francisco to Hong Kong, higher interest rates and falling property values are bringing the commercial real estate market to a perilous precipice. Analysts predict the trouble with commercial real estate will add stress to a financial system already dealing with the regional bank crisis. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Madison.
All right, Amy, thank you so much. We appreciate that. I don't know. I said it once. I'll say it a million times. Bloomberg News is the best.
We are the best.
You guys rip it, man. I mean, it's worth the price of the terminal. I mean, I said it a million times to clients. Get the Bloomberg terminal if for no other reason than Bloomberg News. And they're out there with this story today on Silicon Valley Bank. And you flagged it for me. What's happening out there?
I mean, this is so huge, right? A document from the FDIC, which the agency says it mistakenly released to Bloomberg reporters who filed a FOIA request, okay?
Now, FOIA is a Freedom of Information
Act request, yes, yes. So this document that, again, unredacted, released to Bloomberg News reporters, gives us one of the most detailed glimpses into SVB's biggest customers. We're talking Sequoia, in for $1 billion. We've got another Beijing-based company, Kanjun, I believe is how you pronounce it, received a backstop of more than $900 million. I mean, these are huge numbers.
Yeah, because when I thought about this, when the news was kind of happening, because there are a lot of little small VC startup companies. Yeah. Isn't it nice that we're kind of backstopping them from this situation? But I mean, Sequoia, I got to backstop Sequoia. Mm-hmm. Don't they have like $1 gajillion in assets under management? But they had some pretty big, deposits on there. So I guess they get the same treatment as everybody else.
Yeah, I guess this is the cost of that decision to guarantee every single account. But once you do that, you've got some very big names with very big dollar signs that you've got to backstop.
Yeah, and one of the great things about the story is just that, Bloomberg News files a Freedom of Information Act to get this document. So I assume the assumption was that it was going to be redacted to keep out some of these names, but they sent it out unredacted. And so what do our reporters do? They run with it, as any good, intrepid reporter would. So again, just another really amazing story coming out of Bloomberg News, and we'd like to feature that stuff as well. S&P 500 off 0.6% at midday. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to get a check on the markets here at midday Wall Street time. Plus, we're going to check in with Alice Andres. She's a U.S. interest rates and FX reporter for Bloomberg News. She's got some reporting out today on the macro picture, get a sense of what's happening out there. Plus, we're going to check in with Rania Sedham. She is a managing partner in Sedham Law Group. We want to talk to her about some of the legal issues as it relates from work from home as well as non-competes and all that kind of stuff. It is a vibrant market out there for employers and employees. Lots of change going on, so we're going to get the latest there. But first, let's kick things off with Charlie Pellet.
Hey, thank you very much, Paul Sweeney. U.S. stocks on track for the worst week since March. We have got the Dow, the S&P, NASDAQ all in the red. Do want to begin, however, with Bitcoin up 3.3% right now, but above the 31,000 level. Bitcoin right now 31,130 on Bitcoin. S&P lower by 25. That is a drop of about 0.6%. The Dow right now down 148, lower by 0.4%. NASDAQ down 126, a decline there of 1%. 10-year yield 3.74% with a 2-year yielding 4.77%. Spot gold up $7 the ounce to $19.21. Right now that is a gain of about 0.4%. West Texas intermediate crude below $69 a barrel, down 0.9%. WTI 68.88 a barrel on WTI. Well, as for the inflation backdrop and the economic outlook, Alfonso Pecatiello is founder of the Macro Compass, and he was interviewed moments ago right here on Bloomberg Markets.
We are getting more evident signs, if you ask me, that nominal growth is trending down. We are in a disinflationary wave that has started slowly but surely a few months ago. It now seems to be even accelerating a bit on the downside. And the PMIs, for instance, released this morning, were another sign that the U.S. economy is weakening under the hood.
And you can hear more of that conversation on the Bloomberg Markets podcast. You can download it wherever you get your podcasts. The U.S. Supreme Court is siding with a Coinbase global unit in a ruling that reinforces the ability of companies to channel customer and employee disputes into arbitration. Coinbase shares, they're up right now by 5.5%. Again, we've got crypto higher, specifically Bitcoin up now by 3.1%, 31,093. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Madison Mills and Paul Sweeney in the Bloomberg Interactive Brokers studio. Again, Madison, that Bitcoin news that Charlie was just reporting, that gets my attention. Bitcoin up 3.2%, 31,100. I mean, that's now when you do the RSI function, which somebody really smart taught me about a couple of days ago, it's kind of like right at the top. But it, like a year ago, it traded well above its kind of ceiling, if you will, for a while there. So who knows what's going to go on there. All right, let's see what's happening with these markets. Abigail Doolittle, Bailey Lipschultz, they join us both here in our Bloomberg Interactive Broker studio. They cover all the markets for Bloomberg. So, Abigail, I mean, is that Bitcoin thing? What do you think here?
Let's stick with that topic because I just pulled up the chart of Bitcoin and it's breaking out. And I think that the RSI is going to go higher yet. It is at 74, so it is overbought, but that's an indication of strong bullish momentum. So it's really coming up and off the 200-day moving average. It's taken out the last high. If I were to do a quick calculation on it, actually, frankly, I think it could go significantly higher. I think it could go back toward its all-time high, frankly, right now, based on a pattern that's in there. Now, let's connect that to stocks and other asset classes. Right. And I'm not sure what Bailey thinks here, because I have a hard time with this one. Folks think this year that Bitcoin is a haven. So if Bitcoin is a haven and it goes higher, maybe it suggests or supports what we're seeing with the S&P 500 and those technicals and the Russell 2000 suggesting we could go lower. I don't know, Bailey. What do you think?
No, I mean, well, I was going to ask you, do technicals actually
matter on an asset that's really built on FOMO?
I would say the technicals work the best on Bitcoin because the technical is basically what it is. If you assume it's an efficient market and buyers buy at the lowest price that they can buy at and sellers sell at the highest price they can sell at, all the information that you and I will never find out about is captured there. And so the most important thing to figure out is what the trend is. So right now, the trend on Bitcoin on the year is up. It recently consolidated down, and now we're breaking up and out, back out of that.
Interesting. Yeah. I mean, as you mentioned, it does, if they do get to an all-time high, obviously that's music to bulls' ears. When you look at the spread right now on the NASDAQ 100, right around 4%, which to me is really what stands out. Normally, we had been seeing, at least for the last few years, as you mentioned, Bitcoin trading as a risk-on asset. Now, it seems like almost every day you can kind of pick and choose. If Bitcoin's up and tech's down, well, now it's a haven. And if they're both ripping, well, that's just the optimism there. One thing that does catch my eye, though, obviously we have the Coinbase news, but Coinbase right now up 5.8%. You've got all these proxies all these stocks that trade as proxies. Marathon Digital up 9%, Riot Platforms up 7%. Wow. So it does seem maybe it's a Friday vibe. Maybe we have a summer Friday vibe. Volumes across the board are relatively low, but it has been fascinating just looking at how Bitcoin and a lot of these stocks have been trading in a market that, as we all know, has been led by 7 stocks, and Bitcoin kind of operates in its own little realm.
But Bitcoin, it's up and down, right? Like, if we're looking at this chart and we want to say it in the most plain way, it's up and then it's down. So how do we know that this is not just, a really small and short-lived rally?
Well, you want to look at the trend. At the end of the day, when you're looking at a chart, you're basically trying to see whether it's going up, down, or sideways. Yeah. So that up and down action you're talking about is sideways, but the overall trend when I pull up the 5-year chart is higher, and the overall trend on a year-to-date chart is higher. So those moves down toward support of the 200-day moving average, that's consolidation. And what makes this chart bullish, I think that you'll see Bitcoin, I'm taking a closer look at the technicals right now. I think you're going to see Bitcoin at 40,000 probably in a week or two, actually.
Wow.
And then maybe higher from there. It's breaking out on what's called a bullish flag. So it's basically the bulls had been trying to figure out at 27 whether they should be buying that dip, and now they have the courage and the conviction, and they're taking it higher, whatever the reasons are.
Yeah, again, looking at the RSI function, it seems like the Bitcoin bounced off that 200-day moving average, back in March of 23, and then now just recently, and now kind of moving higher. Bailey, anything else up there on the stock side that you're looking at today? Again, kind of the S&P off 0.6%.
I love looking at some of these speculative markets. But one thing, if I had to pull you, though.
Yep.
Top performing stock in the S&P 500 since the end of April.
Huh.
Oh, I would say I have no idea.
It's not NVIDIA?
Cruise liners.
Oh. Whoa. Good surprise. Good surprise.
No, it's not a meme stock. I wish. Okay. But we do get earnings from Carnival on Monday, and we've been seeing Norwegian Cruise, Carnival, and a number of travel stocks really catching a bid. And one of the things that's going to be fascinating to me, just looking ahead, is that we are going to have earnings from Carnival. And we saw a preview from our colleague Katrina Lewis, but citing a Melius research analyst saying the stock has a lot to live up to. And when you're looking at companies that are up 95, 98, 58%, far outperforming. It's not just a technology. You would think they're almost in the AI space, but it does seem like that pent-up demand and maybe some FOMO going into a probably super busy summer traveling season.
Carnival, it's amazing. Carnival up 95% year-to-date. Royal up 98% year-to-date. Norwegian up 58% year-to-date. So this is a sector call out there. I
was talking to a hotel operator analyst at Morningstar yesterday, and he said that hotel demand in the U.S. and in Europe is at an all-time high. That demand is super strong. So that Carnival, what you're talking about with the cruise liners, it would fit.
Has anybody in this studio ever been on a cruise?
No, and never will be.
No
unless
shot.
Maybe Alaska. Yeah, I know. I feel the same way. I have no interest.
When I was really little, not in.
Okay, so we're kind of 0 for 4 in the cruising category in the studio.
Not you either, Paul?
No, I haven't. I've been on the Disney ones when they took investors out, but that that's when we go out like for a day. We go crazy at night. We come back the next day, and that's kind of it.
That sounds fun.
But no, I've not been on a cruise. But the people that I know, like Charlie Pellet, who are avid cruisers, are just insane when it comes to these things. It doesn't matter. They will go cruising no matter what. So that's why I always thought that industry would come back really quickly. So good to see those stocks. And if I were their investment banker, you know what I would say? Sell some stock right here. Let's raise some capital. You raise it when you can, not when you need it.
Well, that's the thing. You look at Carnival right now; its market cap's around $19.5 billion. They have $36 billion in debt.
I know. You raise it when you can, not when you need it. That pitch worked very well for me for many years. So we appreciate it. All right, Billy Lipschultz, Abigail Doolittle, thanks so much for joining us. You guys cover the markets for us. We appreciate getting a few minutes of your time. Let's check in with Alice Andres, U.S. interest rates and foreign exchange reporter for Bloomberg News. Alice, I know you got a story out there on the Bloomberg entitled "Stocks to Gain as Consumers Hold Recession at Bay." I like this story. What's the kind of the data behind it? Because yes, we are Bloomberg, and you guys always rely on data.
Yeah, I think it was just a little gut feeling that I had last Friday. I just felt like last week I just had a lot of confidence in the market. Powell had spoke, and I just felt like he just was very poised and very confident. And then, he kind of repeated that again this week. And I just felt like he just saw the landing strip coming in. And so I take that, and then I, have to take a look at the fact that we've had, 500 basis points in tightening, and that has hardly put a dent in consumer sentiment and consumer spending. And to me, that's very powerful. And the other thing is that price action in the S&P, you have this slow churn. We got through that 4,200 level in the S&P that was so tough. And then we got to 4,300. And then we got to 4,400 with kind of ease. And then we're passing through these, we're watching these moving averages, 50-day, 100-day, and 200-day, just kind of like glide up. And it's just kind of like during the pandemic when you just saw this like march higher. And I just felt like price action was speaking louder than words, and it was speaking much louder than all the warnings that were coming out on recession or, the economy going into into a deep dive.
Alice, something I can't stop thinking about is Mike Wilson coming on Bloomberg Television last week and saying that the end of the Fed's rate hike cycle was going to be bad for CEOs, for profit margins, for earnings. It just keeps playing rent-free in my head throughout this week. Talk to me about your view on how CEOs can view the second half of this year given the Fed moves.
Well, to me, I think that it means that CEOs can get a little more confident. The whole threat of inflation and higher rates crimping the consumer pocketbook, that becomes now less. If you're going to keep rates steady and jobs hold up and consumers can continue to spend, I think that CEOs can get a little more confident. And this is actually something that I've been writing about since February. As I told you before, I like to lean in on the purchasing managers' reports to me because they're boots on the ground. And these surveys are really deep, and they actually mirror everything that the Fed reports are saying, these Fed surveys that they do of the companies in their region. And what they're saying is that we think that we're going to have a really strong second half. Now, the second half is right around the corner. I'm not saying that it's going to start on July 1st, but what I do think is that, we're still going through an inventory retool. People are definitely getting rid of bloated inventories, that's for sure. But I think that once we clear that, maybe September, maybe into October, I think we're going to see some major strength. And I think that at that point, if the Fed is indicating that they're going to stay steady, I think that CEOs are going to get a lot more confident. They're going to do a lot more new products. I think that they're going to, be bolstering up, and I think that they'll be spending and just much more confident.
So, one of the things, Alice, that's been kind of interesting to me is just how strong the labor market is. And people talk about maybe, companies hoarding labor. If that's in fact the case, are they hoarding labor because they think their business is going to pick up, I guess, later on?
100%. And the thing that you're also seeing, that's one thing I've been writing about again since February, is just this hoarding of labor. And it's not just in services. It is in manufacturing. And the deal is that, they've worked really hard to get their labor pool. And because wages are so high and there's a lot of competition, you could jump ship for a couple dollars. They're able to increase wages to keep these employees. And they're just hoarding. they're hanging on. And the thing is like if there's not work, like if there's not new orders to to produce, you can do other things. This is a very common practice in business. Like, look, if we don't have customers and we don't have orders to fill, you can go do something else. You can rearrange the stock room. You can, we're gonna retool the factory line. We're gonna do this or that. We're gonna work on other projects. So there's a lot to do, and the expectation is that there's going to be strong demand in the second quarter. So you have to keep your employees, because we all saw what happened when you didn't have enough, when you didn't either have enough goods or enough workers to produce the goods during the pandemic, and there was a huge scramble. And so that's why people are keeping their labor markets, their labor pool pretty tight.
Do you see that leading to any sort of wage price spiral?
Well, we just saw today in the S&P Global report that they are continuing to hire and they are continuing to raise wages. And, that's going to be one of the sticky parts of inflation. It's very clear that parts of the economy are seeing inflation come down. You can see that you go into any store and you can see certain things that have come down, but some things are not. You go into a restaurant, it's very expensive. Yep. You go into a grocery store, it's very expensive. Housing sector, very expensive. So, that to me means that people are keeping their wages high. And so they're able to command, higher prices.
Alice, what are we seeing from the small businesses out there? They're the backbone of the U.S. economy. Are they concerned?
They seem not to be. They continue to hire too, and those are like the most vulnerable, right? With the smallest amount of revenue and all that, but they are not. They continue to hire. They're very optimistic. And I think that they feel like they can ride the backbone of some of these bigger firms that are probably going to see some major expansion in the second half.
And on consumer discretionary as well, you talk about the strength of that sector relative to the broader market. What does that indicate to you?
Well, that's exactly what we started off with, that, 500 basis points worth of tightening has not dented at all consumer confidence or consumer spending. One of the things that I like to look at is some of these ETFs, and XLY, which is the consumer discretionary ETF, it's up 30% this year. Yep. And if you compare that to the S&P, which is up maybe 14%, to me, that just speaks volumes that, the consumer is very strong and they're out there spending.
Alice, thanks so much for joining us. Really appreciate getting a few minutes of your time. Alice Andres, U.S. interest rates and foreign exchange reporter for Bloomberg News. Again, out with a very optimistic / bullish piece of reporting. Stocks to gain as consumers hold recession at bay. That's her macro view column out there. So check it out on the Bloomberg terminal. We always appreciate getting a few minutes of our time. S&P 500 off the lows, but still negative, off about 0.5%. The NASDAQ off 0.75%. Yield still lower. 10-year Treasury off 5 basis points, 3.744 on your 10-year Treasury. Commodities front, WTI crude oil off 1%, $68.78 per barrel. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, you mentioned it earlier. Bitcoin hit its highest level in a year, fueled by a renewed appetite for digital assets. That's despite a slew of challenges and calls for regulating the industry. According to Bloomberg data, Bitcoin crossed above 31,013. That was its 2023 peak, and now it's hit its highest level since June of 2022. The surge has brought Bitcoin to around $31,307 and higher by more than 80% since the start of the year. 3M agrees to pay billions of dollars to settle claims related to the use of so-called forever chemicals. Bloomberg's Abigail Doolittle reports.
This company has a lot of litigation hanging over it, so this one piece is now being resolved. We reported earlier this month that they had agreed to pay, in theory, $10 billion to resolve this situation with PFAS, the chemicals used in the foams that help put out fires. Now we are hearing that they are agreeing to pay between $10.5 billion to $12.5 billion. Ultimately, the amount will have to do with how much PFAS are found in water supplies that have not been checked. These basically are municipalities that have been suing the company, and successfully at this point.
Thanks, Abigail. Shares of 3M currently down less than 0.5%. You might have to go somewhere else for your morning Java. Starbucks baristas at more than 150 stores plan to strike over the next week in support of LGBTQ workers. Starbucks United says the walkout will involve more than 3,000 baristas. The move comes after the union's allegations that store employees across the U.S. were told to remove LGBTQ-themed decorations from the walls. The coffee chain in an email says union claims are not accurate. I'm Steve Rappaport, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg. We have got stocks sliding as investors seek safety in bonds. Right now we've got the 10-year yielding 3.74%, but the 2-year 4.77%. The Dow, the S&P, NASDAQ were off session lows, but a lot of red on the screen. We're also on track for a losing week. Right now, the S&P is down 22 points, a decline of 0.5%. Dow Industrial is down 160, a drop there of 0.5%. NASDAQ Composite Index down 100 points, a drop there of 0.7%. Selling across the board with the NASDAQ 100 Index down 0.7, and the Russell 2000 down 17, a drop there of 1%. Spot gold at $19.20 the ounce, higher by $6 the ounce, up now by 0.3%. West Texas Intermediate crude just below $69 a barrel right now at $68.97, recovering somewhat today, down 52 cents, a drop there of 0.7%. Bitcoin, meanwhile, up 3.2% to 31,127 on Bitcoin. Bottom line, though, we're on track for a losing week, the worst week since March. S&P now down by 21 points, a decline of 0.5%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate that. Madison Mills, Paul Sweeney. We are here live in a Bloomberg Interactive Broker studio. One of our stories out on the Bloomberg terminal that's been getting a lot of reads today is Citigroup to reprimand staff for flouting return to office rules. I wonder what the legal issues are there. So when I wondered that, our producer says, I've got a guest that can answer that for you. Rania Sedholm, managing partner for Sedholm Law Group, joins us live in the Bloomberg Interactive Broker studio. We appreciate her coming in. You get a gold star for that, Rania. So, I mean, if they want me in 3 days a week, I go to my boss, you know what, I can do this from home. What are you going to do? What is kind of the legal ramifications for this? You can come in some days. You don't have to come in every day. I mean, what are the legal ramifications?
Well, there are different legal ramifications for the employer and the employee. From the employer side, there's a lot of administrative burdens that come along with allowing people to work either hybrid or remotely, particularly if those individuals are living in 2 different states. It becomes an issue for unemployment benefits and a slew of other things. For the employee, policies are policies, and Even though, it's an at-will state, and many states are, most employers don't just fire people on a whim. They tend to fire people because they've done something wrong, and this is just one box that they can check off. They said you refuse to adhere to our policy, which is reasonable, sound, and non-discriminatory.
Well, on that, have the circumstances that employees can cite to allow themselves to work from home more frequently changed at all? And how does that play out from a legal perspective? For example, if an employee is saying that they're experiencing a disability, they can't fulfill the work in office requirement. How is that looking now compared with pre-COVID?
I think the ADA hasn't, Americans with Disabilities Act, it hasn't changed much. And certainly if a reasonable accommodation is to allow someone to work from home, there's an obligation to allow that person to do just that. But that's, it may be temporary. It depends on the nature of the disability, right? It has to be something that's supposed to last at least 1 year, not necessarily perpetually.
Right.
I think what I hear from a lot of people is, listen, it's been proven I can do my job as effectively from home as I can in the office. Why do I have to come in? But they don't, that's fine from a business perspective. But from a legal perspective, has anything changed? Like if the employer doesn't like how you're performing, including not coming into the office, they can fire you, right?
Sure, they certainly can. There has been some talk about individuals who are working from home still accomplishing the goals of the job, but maybe not on a timely basis. So, for example, if you're in the office from 9 to 5, 10 to 6, whatever the hours are, the employer sees you there and you are supposedly doing the work for the company. If you're home, you may take a 2 to 3 hour break midday to do something unrelated to the job. And so some employers now are talking to me about why they are having problems with timely performance as opposed to performance overall.
Well, that's interesting, but that's something that, again, would just be used as kind of part of a performance review, right?
Yes, correct. It would be part of a performance review. It may affect someone's ability to get a raise for the next year, or perhaps it'll affect their bonus.
All right, let's say I took a job before the pandemic based in New York City, and then the pandemic hits and I relocate to, I don't know, like Sheboygan, okay? Lower cost of living. But I keep, lower cost of living. But I keep my New York, salary. Can employer come back and say, you know what? Like I even heard some in tech companies like Facebook in the beginning of the pandemic say, yeah, you can work remotely, but we're going to cut your pay. Can they do that?
That's a very gray area. It's a tough question. There is something in the law that states that you're constructively discharged if your pay is affected negatively by 20% or more. That being said, if the company has a policy that pay changes according with the cost of living, if you move, then that's a different story.
What are not that I know anyone who's ever done this, but what are the legal ramifications of an employee moving to Hawaii and not saying anything?
Oh, actually, I experienced this with one of my clients. Not to Hawaii, but to other places. What happened to my client was they received a nasty letter from the state where the employee had moved, telling them you did not register to do business here. You don't have unemployment insurance, which is mandatory. You don't have workers' comp insurance, which is mandatory. And so we scrambled and obtained the insurance. And now we have a rule in this company that, number one, if you move, you have to let us know. I think that's pretty reasonable. 30 days advance notice. And you can only move out of the state once per year. They haven't yet said you have to move to a state where they're already doing business, but some companies, may want to have a rule like that to protect themselves.
All right, another issue, kind of employee-employer kind of thing that's always got my attention, non-competes.
Yes.
Are they, like I worked on Wall Street my entire career. We had this little thing called garden leave, which is a scam, but talk to us about the world of non-competes. Is that still a thing, and how enforceable are they?
It is still a thing. It does vary from state to state. In New York, the non-compete has to be reasonable. That's in quotes. You know, lawyers love arguing about what's reasonable and what's not reasonable. There are some bright line rules that you can adhere to. The first one is time, right? 6 months is considered reasonable unless you're paying somebody to be on garden leave, which is essentially do nothing and we'll pay you. That, is as reasonable as the two parties want because you're getting paid. The other one is a geographical boundary, right? Where is it that you're prohibited from working? That will change depending on the nature of your job. Some people, rather than have radius restrictions, will just delineate 2, 3, 5 companies that they consider their top competitors and just tell you you can't work with those 5. It has to be reasonable in New York. Some states disallow them altogether, but as we were speaking very briefly, there is a bill right now awaiting Hochul's signature that may prohibit non-competes in New York entirely.
So there would be no scenario where a non-compete
Well,
would be...
it's too early to know.
Yeah.
There is the power of the pen, and she may use it to strike some of the language or modify it. But as currently written, there is no exception.
Because I think about some of the big employers in New York City, law firms, investment banks, things like that, who do use non-competes. I would think there'd be television newsrooms. I would think there would be some pushback on that from the business community.
I don't think the business community will be very happy, and without an exception, it'll really hinder a lot of deal making because technically I can sell you my business if there's no non-compete and then start another company the next day.
Yep.
So we have to wait and see. Hopefully there's a pen handy.
Okay, really quickly here. I always like to monitor the New York requirements when it comes to posting salaries next to job offers. How would you rate how that's been going? It was a rough initial turnout.
Yes.
And now we've had some time. How do you feel about it now?
I think that some of the job advertisements that I see are comical when it gets to compensation because the range
is hilarious.
Is so vast, right? So I'll say director of something needed salary $50,000 to $500,000. Wow, thank you so much. That clarifies everything. That does technically abide by the rules as written. I don't think it's in the spirit of how the rules were intended, and I think more time is needed to really iron things out and figure out what should and shouldn't be included.
Employers, are they allowed to ask a prospective candidate what they want to make in this role?
What they want to make, yes. In New York, you cannot ask what are you currently making.
Okay.
But you can certainly ask what are your salary expectations.
So you can't say what are you making and then that'll give me some leverage.
Not in New York. Not in New York. Other states is permitted, but you have to be careful because if you're doing a Zoom or telephone interview, you don't know where that person necessarily is, and you should just don't ask that question. Instead, tell them how much you want to pay, or ask them what they want to make.
Okay, all right, learning something every day, and it's changing in the I guess hybrid world. Ronnie Sedholm joins us here in our Bloomberg Interactive Broker Studio. She's a managing partner in Sedholm Law Group. Just kind of getting some clarification on the employee relationship, ever evolving and evolving in different ways since the pandemic, for sure. Right now, let's head down to Washington, D.C. We'll get rolled in national news with Nancy Lyons.
Thanks, Paul. The Supreme Court says the Biden administration has the right to shift the government's immigration priorities to focus on removing people who cross the border and are a threat to society. The policy's been on hold after 2 Republican-led states, Texas and Louisiana, contested that approach. The justices ruled 8-1 with Justice Alito, the lone dissenter. The justices found that the states lacked standing to bring the suit. President Biden today is signing an executive order aimed at expanding free access to contraception. It's his 3rd executive order since Roe v. Wade was overturned a year ago tomorrow. The order will increase ways for women to access contraception and lower their out-of-pocket costs.
Centrists in the Republican Party are taking steps to win back women in time for the 2024 election cycle. We get more from Bloomberg's Amy Morris.
Republican lawmakers have successfully kept abortion ban bills off the House calendar for months. They've coaxed promises out of leaders to bring forward legislation to address rape kit backlogs, help make child care affordable, and boost access to birth control. They're responding to larger trends on public sentiment after the Supreme Court struck down Roe v. Wade. Republican moderates say they can't walk away from abortion restrictions entirely, but they should avoid policies that step too far into personal privacy. In Washington, I'm Amy Morris, Bloomberg Radio.
Interstate 95 in Philadelphia is once again open to traffic. Pennsylvania's Department of Transportation says 6 temporary lanes have been constructed following that fiery truck crash nearly 2 weeks ago that caused a partial collapse of the highway. Initially, it was believed it would take months to restore traffic, but a decision was made to construct the temporary roadway by filling the damaged stretch with recycled glass and pavement. More permanent repairs are expected to cost between $25 and $30 million. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. A lot of red on the screen as we wrap up a holiday-shortened trading week with the Dow, the S&P, NASDAQ all declining right now. Right now, the S&P is down 1.1% on the week. Today, we're looking at a loss of just about 0.5%. The S&P down 21 points now to 4360. Stocks are sliding as investors seek safety in bonds. We've got the 10-year yielding 3.75%, but the 2-year now 4.77%. The Dow down 156, drop there of 0.5%. NASDAQ lower by 88 points, a drop there of 0.7%. The Russell 2000 down 0.9%. Cannot ignore Bitcoin today, 1-year high, up at 30,949. A gain right now of 2.6%. Bitcoin was above 31,000. Spot gold trading higher by $6 the ounce to 19.20, up by about 0.3%. It is crude oil that is lower, back below $69 a barrel. West Texas Intermediate crude down now by 1%, 68.81 a barrel. Bottom line here, stocks on track for the worst week since March. Anxiety is rising, but central banks will have to ratchet rates higher to tamp down inflation. Well, as for the market backdrop, Jason Dreo is head of tactical asset allocation at UBS Financial Services.
I think we are in a bit of a consolidation phase for the markets until we get probably the next round of data for June starting in a few weeks, which will either kind of reinforce the momentum in the past month of kind of soft landing taking hold and investors position for that, or that proves to be a bit of a false hope. I would think that it's probably leaning more towards the former than the latter, but I think that's kind of where we are right now.
You can hear more of that conversation on the Bloomberg Surveillance podcast. You can download it wherever you get your podcasts. Nikola says it expects foul play after a fire broke out at the electric truck maker's Phoenix headquarters that affected multiple vehicles. No one was injured. An investigation is underway. The situation, though, adds to headaches for Nikola, which said last week it would cut 270 jobs to reduce expenses and preserve cash. Right now, we have got shares of Nikola. They are trading lower today. Again, recapping, the Dow, the S&P, and NASDAQ all lower. S&P down 20, a drop now of 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. Madison Mills and Paul Sweeney here in the Bloomberg Interactive Broker Studio. ESG, environmental, social, governance, it's a thing. It's part of investment analysis. It's growing. Assets are flowing to it. And when we want to talk ESG, we go to I think one of the smartest people in the building on this whole ESG thing, and that's Shaheen Contractor, ESG research analyst at Bloomberg Intelligence. She joins us here in our Bloomberg Interactive Broker Studio. Shaheen, give us a sense of just kind of where we are with ESG investing in terms of, how many assets are under management? Is it growing? Where's the growth? That type of thing.
Sure. First, thank you, Paul. That was very sweet. So we started sizing the ESG fund market probably for one of the first times, the world beyond ETFs. And what we find is the market is about 2.3 trillion today. And there are three main takeaways. So first is Europe is about 85% of it. So yeah, a lot. And we think Europe's lead is actually going to widen over there. The second thing is, if you look at themes, environmental and climate themes are a major chunk, about 20%, big growth since probably the last 4 or 5 years. And the third piece is a lot of growth has been due to rebranding. So in other words, funds changing their name to ESG. That's been pretty much a huge driver.
So then how do you suss out whether or not a fund is actually practicing environmental social governance versus just naming themselves that?
Yeah, it's a good question. I think it comes down to looking through to the holdings. So what I do at least is I look at sort of ESG scores, ESG metrics, and roll them up to the fund level. And what you're really looking for is it different from your benchmark? Because if it's not, what are you paying for? And of course, funds have different objectives. It's really hard to suss that out. But I think there are some metrics that you can just, start to get a sense of.
All right, at Bloomberg Intelligence, which is Bloomberg's investment research business, close to 500 analysts around the world covering 2,000 companies, 138 industries. How many people do we have covering ESG?
Oh, I want to say it's close to 20 now.
20 people around the world focusing on ESG.
And Paul, you remember it was one?
It was one, exactly. It was you.
Yes.
So that shows you how important this is to investors. Because if we're investing resources at Bloomberg into ESG, we're doing it not because we are fans or not fans of ESG, it's what our customers want at Bloomberg. Why are 85% of the assets in Europe, and why is the U.S. not a bigger piece of that?
So Europe has always been the dominant player. So they started about maybe 10 or more years back, and it was really a drive by their pension funds. The U.S. has been taking a bigger share of the pie, but that's sort of cut back maybe since about last year. A large share of the pie was driven by ETFs. About 40% of that asset base in the U.S. is ETFs. Outside of that, the share has not increased too much. I do want to say, though, that funds is one way to track it. There's a lot of money that, say, is in a pension fund just investing, and you just can't track it. So this is, one view of it.
How big of a headwind is the political battlefield surrounding ESG in the U.S. to those numbers you just talked about?
It's quite a bit. So the view I have always taken is that, we saw a decline, right, last year. I don't think that decline was due to the political backlash. It was sort of concentration risk unraveling. But I do think going forward, it's going to sort of prolong that slowdown and stop what I call the widening of the investor base. So basically, to continue that growth, you needed a wider investor base, and this is just going to sort of stop that.
Right. Is there any sense when you talk to people in the ETF space or just the ESG space in general that tide is going to change, or is this something that feels like it's something that the ESG investors are going to have to deal with?
It depends on who you speak to. I think most of those people I speak to are ESG people, so they all think the tide is going to change. We don't know the reality.
I mean, BlackRock, the biggest asset manager on the planet, they are big proponents of ESG, correct?
Yeah. They have probably the lion's share of ETFs out there in terms of assets.
I think a lot about this, and this is stated pretty plainly in one of our colleagues' pieces about this anti-ESG bill in Congress, where Andy Barr, Republican from Kentucky, straight up says this effort is about taking politics out of investing, depoliticizing asset allocation. If the U.S. continues to move towards that, particularly if we end up with an even redder Congress, how bad could that get for the ESG space?
I'll just reiterate that there's nothing political about ESG. I feel like they're doing the exact opposite. The regulation is definitely going to make things worse as it, gets more into that. So we'll just have to wait and see.
Is there good data out there so investors can, make a good decision about whether a company is supportive of ESG type of parameters or not?
Data is improving. I won't say it's perfect.
Okay.
The G has always been the most used, probably the most popular. Outside of that, probably ESG scores, because they sort of fill gaps where it's not available. When you go to certain sectors that are not environmentally sensitive, things like tech, finance, things like that, it gets pretty patchy.
So, but for our Bloomberg users, one of the most widely used functions is FA for financial analysis, and that's where you see the income statement, the balance sheet, the cash flow statement, all that kind of stuff, ratios and segments and stuff like that. There is now, and there has been for a long time, a dedicated tab, just like there is for an income statement, just like there is for balance sheet, for ESG. And there's all kinds of data there for ESG. And do investors, do they use that? How important is that, do you think?
So underlying data to me is actually the most important, right? It's what backs into and feeds into scores, and you really need that transparency to understand anything.
All right, so again, you put in any ticker for any security, and you put in there FA for financial analysis, and one of the tabs there would be ESG, and you can check out all the ESG data, ESG disclosure scores, and all that kind of stuff, and you can compare companies. So Bloomberg takes it seriously, and that's because our clients of the Bloomberg Professional Terminal take it seriously. So, but as Shaheen was saying, it's much, much bigger for European investors or just non-U.S. investors. Shaheen Contractor, thanks so much for joining us here. Shaheen is ESG research analyst from Bloomberg Intelligence, joining us here in our Bloomberg Interactive Broker Studio. S&P 500, we're off about 0.5% today, a little bit off the lows. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, Boeing's largest supplier, is resuming contract talks with union workers as the aircraft maker hopes to step up production of its best-selling jetliner. Spirit Aerosystems employees voted to authorize a strike despite reaching a tentative deal last week. The dispute shut down production of fuselage assemblies for the 737 MAX. Shares of Spirit are up right now while Boeing stock is down. Citigroup ups the ante to get remote holdouts back on site at least 3 days a week. Sources tell us managers have been instructed to consider attendance when rating performance and crafting pay packages. Bloomberg's Sonali Basak has more.
For Citigroup, it's still seen as one of the more lax policies on Wall Street. Remember, BlackRock more recently told their employees 4 days a week, please, be in the office. We have a new office in Hudson Yards, and we want you all to be together. It's needed for mentorship. It's needed to do things faster, better, stronger in a tough environment. But listen, for Citigroup, it's still majority of the employees here 3 days a week. And so that is a little less than what you're seeing, for example, over at Goldman Sachs. So even with the lax policy, this is showing you that if you're not complying, there will be consequences. You can't have some people that are complying and others that take the rule a little less seriously.
Thanks, Sonali. The Supreme Court sides with a Coinbase Global ruling that reinforces the ability of companies to resolve disputes with employees and customers through arbitration. The 5-4 decision means lawsuits filed in federal court must remain on hold while a defendant presses for an appeal to send those cases to arbitration. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg. Bloomberg Markets continues after this.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Hi, Bloomberg Markets. Madison Mills, Paul Sweeney here, looking at these markets. S&P 500 off 0.5%. NASDAQ off about 0.7%. That VIX sitting down below 13. I'm calling that out for Tom Keene, 12.96 on your VIX here. WTI crude oil off 1%. So we're at $68.72 a barrel WTI crude oil. Let's head down to Washington, D.C. right now. We'll get world and national news with Nancy Lyons.
Thanks, Paul. Search teams continue to look for answers following the discovery of debris from the Titan submersible. The Coast Guard says an official investigation has not been launched so that the agencies involved can continue to search the ocean floor for pieces of the vessel. Bob Ballard, an expert in deep-sea exploration who discovered the Titanic's resting place, tells ABC he believes the Titan had major flaws and was never certified.
We've made thousands and thousands and thousands of dives with other countries as well to these depths and have never had an incident. So this is the first time, and the smoking gun is this is the first time by a submarine that wasn't classed.
Ballard referring to the lack of classification by shipping authorities. It's not expected any of the 5 crew members will be found and brought to the surface. Today marks the final day of Indian Prime Minister Narendra Modi's visit to Washington. He's meeting with U.S. and Indian business executives today. President Biden has rolled out the red carpet for Modi, but Richard Haas, president of the Council on Foreign Relations, tells Bloomberg India is a fickle friend that still has ties to Russia.
It still gets most of its arms from Russia. It's buying copious amounts of Russian oil and gas. It hasn't supported us diplomatically there. It's a reminder that India always hedges in its foreign policy.
Haas says there is growing strategic cooperation between the two countries, but he's not buying all the hype. The Supreme Court is siding with the Biden administration in a case involving immigration. By a vote of 8-1, the justices ruled that Texas and Louisiana do not have standing to prevent the administration from prioritizing the arrest of illegal immigrants who are suspected terrorists or dangerous criminals. Both states had claimed that the Biden policies violate federal statute. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Paul and Madison.
All right, Nancy, thank you so much. We appreciate it. You know, Madison, one of the strategists and stocks and markets voices that I like to listen to a lot is Morgan Stanley Wealth Management's Lisa Shallett. She was on Bloomberg Television today. She says U.S. stocks are vulnerable to a pullback of 10 to 15% as valuations remained stretched. And in her words, it's about looking at risk-adjusted returns, she said on Bloomberg Television. We still believe from here, American stocks, as measured by the index, are very vulnerable to a 10 to 15% correctional pullback, given that expectations and valuations are quite rich. So that kind of gives you a little bit of a pause, because she does this stuff for a living. She's been doing it for a long time. And I think she's just saying, you know, bonds may be a little bit more attractive here relative to stocks.
Yeah, I mean, and this mirrors the house view kind of globally for Morgan Stanley. Note this morning from one of their strategists out in Europe, Graham Secker, saying that improving investor sentiment suggests increasing risks for stocks if growth data does indeed start to slow. And Morgan Stanley's Global Risk Demand Index is also giving signals to sell as well.
Yeah, and looking at the S&P 500 and using the relative strength index RSI, looks like the S&P index was kind of in that overbought territory. And it kind of peaked around June 15th, and it's been kind of coming down since then as the market's sold off here. So it kind of flashed that overbought signal back there a week or so ago, and it's been kind of trading, just more on technicals, it feels like. But Lisa Shallett saying, just from a risk reward and evaluation perspective, 10 to 15% downside from here potentially.
I mean, that's not good.
No, that would be a little bit of a dent. The S&P's, had a strong move off of those October lows, 22, 23%. NASDAQ, more than that, 32, 33%. So off of those October lows, a big move up in these markets, anticipating, amongst other things, that the Fed is, if it's not done tightening, it's pretty darn close to it. So we'll see how that plays out. That does it for us today. Coming up, Sound On with Joe Matthew in Washington, D.C. That starts right now.
from New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, global bonds rallying hard to end the week, even as hawkish central bankers take the stage, all while investors weigh the opportunity costs. We begin with the big issue. Is inflation or recession the biggest risk?
We're facing still, globally, a serious inflation problem.
Core inflation remains quite high.
You've got to see some abating of that inflation.
Central banks feel compelled to attack that aggressively.
Central banks have had to come back to the table.
This is clearly a hawkish tone from the UK and from Norway.
ECB and Bank of Canada.
The most hawkish pause I could have imagined.
The question is, will they call victory at 3%?
We're not clearly at the end of the tightening cycle.
Clearly, rates have to go higher from here.
We are only now getting to tight policy.
The monetary tightening will trigger recession.
All of the empirical evidence, the surveys, are all pointing to recession.
The recession risks here are growing.
The recession will happen.
Recessionary headwinds are going to catch up with us.
With the Fed and all these other central banks having tightened policies so aggressively, it does start to bite, and it is starting to bite.
Joining us now, I'm thrilled to say we have Oksana Aronov of JP Morgan Asset Management and Laird Landman of TCW. Laird in LA, Oksana on set with me. So I'll start with you. Seems like we entered this week where it was pretty clear that inflation was enemy number one. Now we got some soft PMIs from the Eurozone this morning, also from the US. In your view, are we anywhere close to the point where central bankers start to focus more on the risks to growth rather than inflation?
So I think that a lot of people answer that question from the standpoint of what they would like the central bankers to do. And I think we really have to get into the head of central bankers who, of course, without a doubt, have lost so much credibility in 2021 and early 2022 with the whole sticking to transitory, that now they really have to demonstrate the heft they're willing to bring to this inflation fight. And without a doubt, you still have tremendous examples. For example, the UK earlier this year. What happens when you fall behind in the fight with inflation? So I don't think any central banker wants to make that mistake. So absolutely, I think inflation remains enemy number one. If you look at core inflation, it hasn't essentially budged on an annualized basis for the last 6 months. And if you look at core services inflation, it's actually higher than where the Fed started to fight inflation. So I think this this remains really the problem number one for them. And it's really hard to point to anything in this economy and say, this is recession right here.
Mm-hmm. Well, Laird, in trying to get in the head of central bankers, it's probably helpful that we keep hearing from them. We heard from Jerome Powell earlier this week on that 2% target. Let's take a listen.
It is working families who suffer most directly and quickly from high inflation, and it is for the benefit of those people and all other people that we need to restore 2% inflation in this country on a sustained basis.
2% on a sustained basis. If you look at headline CPI, we're around 4% right now. What does the path back to 2% on a sustained basis look like?
It's a lot longer than maybe Jerome's giving it credit for at this point. I think that there are really sticky elements that we have to overcome now that involve wages, service industries, areas that are still, doing very well, like travel, where there's a lot of demand. I think it's going to take a while for us to get down to 2%. I think that the path is going to be encouraging, but as we look around out there, what's built into the market pricing, when you look at tips with break evens of anywhere from 211 to 230, we think that that's not in the next year sort of time frame for us. So I think that we're going in the right direction, and I think it will probably cause various central banks this slowness to overcome services inflation. It will cause some of the central banks, I think, to go a little farther than they otherwise would have and tip us towards recession.
Let's talk about TIPS, which you bring up. I was looking at your notes. I was delighted to see that you highlighted the iShares TIPS ETF. Of course, the ticker there is TIP. If you look at the demand, it really hasn't been there. I mean, that ETF is on track for $1.5 billion of outflows this year. With the inflation that we're dealing with, I mean, are you surprised to see that investors aren't reaching for TIPS?
It is a little surprising, but they've been very disappointed. I mean, if you were calling for inflation in 21 and 22 and you reached out and bought a lot of tips as an individual investor thinking that would be a good hedge, it really didn't work out well at all because real rates dominated the return, and real rates went from being negative to today being at around 1.6%, according to the tips market, and you got killed. In many cases, you underperformed nominal treasuries of similar maturities by owning tips. So it really has been a bad ride, and it's not surprising to see sort of the retail side of the equation bailing out of the ETF at this point. We actually think tips now represent pretty compelling value at TCW.
So pretty compelling value at TCW. What is the JP Morgan asset management view on tips? As Laird just laid out, they haven't really done super well in this inflationary environment. Do you think that they make sense here, or are there better inflation hedges?
So I answer that question from the standpoint of an absolute return-oriented investor, which is somewhat different from a more benchmark-aware investor, right? So my neutral point for risk is essentially liquidity. So when we don't feel there are enticing opportunities in the market, we will retreat back into liquidity until such time that there are opportunities that we feel we're being compensated for adequately. And today, there's really a dearth of those, and tips do not really represent a tremendous opportunity in our opinion, because the duration, and they do tend to be longer duration instruments, absolutely is going to dominate the risk there. And to the extent that we believe the Fed is going to continue to either kind of be on that pause or even hike further, these are not going to be immune to that interest rate risk. So we think that there is much better value right now in combining, having some dry powder in your portfolio, which is, you're earning 5+% at that very, very front end of the curve, and then attacking opportunities as they arise, which certainly we've seen some in credit-related markets, not as much as we think will come our way over the next 10, 12, 18 months as we start to approach those maturity walls in credit, as the consumer perhaps turns over, which we have not yet seen, as some of these commercial real estate issues come to pass. So there are going to be really, really attractive credit-related opportunities. But right now, have powder dry, preserve optionality for when that happens.
Let's talk about that dry powder, because one of the reasons I was so excited to talk to you today is I know that in your portfolios, you love cash, to put it bluntly there. And then you look at some of the money that's been coming out of money market funds. I believe, according to ICI data, we're on track for 2 straight weeks of outflows there. What is sort of the bull case for cash right now, which feels a little silly to say, but what is the value proposition?
So we don't necessarily love cash when the opportunity is there to deploy your capital for, interesting returns, great returns. In today's market, however, whether you look at interest rate risk or credit-related risk, you're just not compensated for the risks, right? So if you're moving out on the curve and deploying that cash into longer duration instruments, you're essentially immediately incurring 150 basis point roughly drop, at least, depending on how far you go. And that's just not compelling to us because, again, we believe the Fed is not going to deliver the cuts that are still priced into this market, still priced into that longer end of the curve. So you will continue to be very well compensated at the very front end of the curve, which, for us, that's a fixed income asset class. And then from a credit standpoint, when you look at what are you being compensated for, some of the worst quality companies out there, the junk rated companies, double Bs are yielding in the 6s, and cash is giving you 5.25. So really, do you want to take that dry powder and deploy it into that part of the market? And even overall, when you look at high yield credit, where yields are in the 8%, it will only take about 120 basis points of widening there to wipe out that very juicy yield, which is very quickly, it's something that can happen very, very quickly in high yield. So do we see opportunities? Have we seen opportunities? Yes, we've seen opportunities in bank-related paper on the back of some of the stress created both in regionals as well as Credit Suisse being pushed into the arms of UBS. So there were things to do there with IRRs of 20 to 30%. But we think that that's just the beginning of the effects of higher rates for longer, and there will be more and more opportunities like this as we go through the next 10 months.
Well, Laird, weigh in on that. How are you thinking about, 5% yields at the very front end, no duration risk, versus maybe the opportunity costs of being in cash overweight here?
We never think of this as rocket science. The cycles play out in a reasonably predictable way. This has been a much faster, violent cycle than we've seen in a long time. But the next moves, the next sustainable moves are probably, whether it's the end of this year, beginning of next year, is that monetary policy, working with a lag, will cause a slowdown in the U.S. economy. We will get a turnaround. The curve will, at some point, renormalize. Volatility will come down. Interest rate volatility will come down. So there's a lot to do for institutional investors out there. You want to be positioned in the short end, but you want to have a lot of duration also. So there's a variety of techniques you can use to do that. That's the way TCW is positioning right now. We're trying to basically get as much exposure to sort of 1 year to 3 year parts of the curve as possible, but still maintain a longer than average duration, because we do think that the long-term price action is going to be favorable. That is, rates will be coming down over the next couple years. We don't think 1.6% real rates is sustainable for economies that have 300% plus leverage on them, as the Japanese have proved. And so, we think that those are the trends you want to look for. That is, renormalization of the curve, long-term rates coming down, volatility coming down. Agency mortgages make a lot of sense here. TCW has basically almost gone all in, so to speak, on our agency mortgage positioning. We agree with your other guests that credit's not there yet. We're broadly neutral there. We did get a nice thing with Credit Suisse, but outside of that, we don't see a lot of opportunities.
Okay, so I think it was a portfolio manager from TCW who called those agency MBS a screaming buy, something along those lines. So makes sense there. But I do want to talk about a phrase that you brought up, sort of the normalization of the curve, because I'm looking at a 2s-10s curve that is a full percentage point inverted. It feels a far way away from normal. Are we at the depths of this inversion? Are we at peak inversion across these curves, or do you think there's more to go there?
Well, I certainly think there's more to go in the UK, in Euroland. I think they're underestimating the amount of tightening that's going to need to happen to really feel that they've knocked inflation expectations out. In the US, we're probably within 25 basis points of peak inversion. And the inversion has, again, this is the long and unpredictable lags of monetary policy. M2 growth, which people can knock looking at that in a million different technical ways, but it's been negative, I think, for 9 months now, more negative than we've ever seen it. It's working its way through the system. The problems in the regional banks is going to cause credit to be pulled back in many of the smaller parts, the small business areas of the economy. And I think all that adds up to, we're probably headed for, a recession. It's sort of the Kobayashi Maru, the no-win situation of fixed income. With this inflation, we'll raise rates until we have a recession. And I think that's what's happening.
All right, good place to end it. Really appreciate both of your times. That is Oksana Aronov and Laird Landman. Thank you both so much. Up next on this program is the auction block, issuance on a hot streak, especially in Europe. That's next. This is Real Yield on Bloomberg.
Replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the auction block where the sales remain hot. In fact, Europe, it's on its longest continuous streak of bond sales since October 2021. The record was set during a week that saw 21 billion euros of issuance. And helping to drive that number was NASDAQ, which had an offering in both Europe and the U.S. this week, saw sizable demand for both of those sales. And over in U.S. high yield, 6 companies lined up to sell more than $5 billion of bonds this week. There was an early rush in the week where Tuesday saw the most sales in one day since January. Meanwhile, Matt Miskin of John Hancock Investment Management says that now is a great time to look at higher quality fixed income.
There's just not a lot of risk being priced in. And right now, the time to fix a roof is when the sun is shining. When we look at portfolios that have been overweight risk, that have actually done well this year, you've had to have real risk on to do well and outperform this year. We would look to trim into some of this strength and redeploy into higher quality fixed income, take some chips off after such an exceptional run.
Joining us now, Ken Monahan of Amundi Asset Management and Michael Contopoulos of Richard Bernstein Advisors. And Michael, I want to start with you because higher quality fixed income, I've been hearing that for months. How crowded is that trade at this point?
Based on all of the previous interviews, I'm getting a little bit nervous about it, Katie. But I think you're still supposed to be there. The question is what type of high quality assets, because they're not all created equal. So some will say that the investment grade market is a good place to be. I mean, that's high quality certainly, but we don't think corporate credit is actually where you want to be positioned at the moment. So there's a lot of different types of high quality. And so I do think that you do want to be there, but you still have to be careful with which specific areas.
Well, let's talk about a specific area that I saw in your note, Michael. Agency MBS. You say that it's getting more attractive, but you're not yet all in. That was interesting because there was a great piece on the terminal this week from some of my colleagues quoting TCW saying that mortgage bonds are just screaming cheap. It sounds like that's not your view. What are you waiting for?
Well, they certainly are cheap, Katie, and the fundamentals are fantastic, right? I mean, you have virtually no default risk. You have no prepayment risk. All these bonds have extended, so you do have duration, but we're actually comfortable with that duration. But the problem is that we don't know exactly yet what the bank crisis is going to ultimately play out as. And if we have more banks and more bank selling of mortgage paper, that could yield ultimately, higher spreads in the asset class. I mean, you've lost your 2 biggest buyers, the Fed and banks. And so from our perspective, there's no rush here. I just don't see how spreads are going to rip tighter in the near term, given some of the technical and structural headwinds in the market. So I don't think there's a rush here. We'd rather have some certainty that the market has the all clear signals. And if we miss a little bit of upside waiting for that certainty, that's fine because of the fact that there are other opportunities elsewhere that are pretty attractive. But with that said, we are adding, but we remain underweight after having been very underweight last year.
Ken, come in here. When you look across the totality of the corporate credit market, where looks crowded and where is there still opportunity?
Well, I take your guest's previous point, which is that there's a great deal of value in the optionality of cash right now. There's not a lot of parts of the market that look exceptionally cheap at the moment. I think the comment that was made about mortgage securities, agency mortgages looking extremely cheap is accurate. And while they may get a little wider here because you're right. We can't really tell what's going to happen with the banks and what's going to happen from a regulatory perspective. And the Fed's still a selling agent here. We would say that it's a pretty good entry point. When we're looking at investment-grade corporate debt and we're looking at high-yield debt, they're clearly trading at the tighter end of the range that they've been in the last 12 months. And we really can't pound the table for high-yield in particular and say that it's screamingly cheap, because it's not.
Well, guys, entry points have come up several times in this conversation already. So I want to bring you Allspring Global's mid-year outlook. They wrote that falling rates should drive returns on IG bonds and adding duration should benefit portfolios when yields fall. They also write that the opportunity cost of waiting for a perfect entry point is high and it's difficult to time. So Ken, when you're thinking about entry points, specifically when it comes to duration, are you looking out the curve here, or are you still staying in cash?
Well, when it comes to duration in the United States, we think we're getting to a pretty interesting territory here. Kind of in the 3 3/4 to 4% range. We haven't hit that magic 4% number. We think that that's the time to probably get in if we're talking about where the 10-year is.
Okay, so that's the time for the 10-year. Michael, weigh in on that. When you look across the curve, I mean, what is the case for duration here? And is that the case that you're making to your clients?
Yeah, well, let me first address the Allspring quote, because I couldn't disagree more, quite frankly. What I would encourage every single investor to do who's listening to this program at the moment is when they hear a comment like that, ask the portfolio manager where the returns are going to come from. And Allspring hit the nail on the head. It's coming from the risk-free component, lower treasury yields. So if that's the case and it's not coming from a collapse in spreads, why not just own the risk-free component, i.e. treasuries or something similar to treasuries? There's no reason to add spread risk if all your return is coming from lower, risk-free yields. And so from my perspective, there's no relative value at the moment, given where spreads are in corporate credit. There is relative value in duration. And I think a barbell approach makes all the sense in the world, where, you can own front-end treasuries or AAA CLOs. You can own floating rate treasuries with 5-6% yield, and then barbell that with longer-term treasuries like the 20-year or the 30-year, and you get the total return potential of the long end coupled with the high yield at the front end.
Yeah.
And I think you could do that today and feel really good about levels. And so from the instruments I just mentioned, we're there, and you should be involved in those parts of the market today. And high yield, I mean, I want to see high yield north of 800 basis points. I want to see IG north of 170, 180 basis points before I'm really excited about IG and high yield.
I really like that point. Just cut out the middleman. Just buy the risk-free rate. Ken, 30 seconds, weigh in here. When you think about treasuries, what is the sort of valuation, the relative valuation relative to the corporate credit market?
Well, I take Michael's point is that if you're looking at credit right now, it's not exceptionally cheap. High yield spreads are, again, as I said, at the narrow end of the range. We've been running at about 125 basis point range this year. We're clearly, about 425, 430 in that narrow end right now. We got as tight as just inside 400. We got as wide as 525. At 525, 600 range, we'd say high yields are pretty attractive, because we think when we have a slowdown, which we're expecting perhaps as early as the fourth quarter of this year, it's going to be a relatively mild one, and high yields improved in quality over what it was 10 years ago. But we can't say high yield is cheap, and investment grade corporates right now are not either.
All right, guys, got to leave it there. Really appreciate it. Ken Monahan and Michael Contopoulos, thank you. Still ahead, the week ahead. That's next.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead coming up on Tuesday, consumer confidence from the Conference Board. Wednesday, we get the stress test results. Thursday, we get U.S. GDP. And then Friday, we'll round out the week with the Fed's preferred inflation measure. But let's talk about those bank stress results. The standards are tougher versus a year ago, so we'll see how the U.S. big banks fare. But from New York, that does it for us. This was Bloomberg Real Yield, and this is Bloomberg.
Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg.
Welcome to Bloomberg Markets. I'm John Ehrlichman.
And I'm Matt Miller. Let's get a quick check on what's going on in the markets right now. Kicked off by concerns about a European recession. We're now worried about a U.S. recession, as well as the flash PMIs come off for manufacturing. The S&P 500 down 0.4% at 43.64. The 10-year yield right now coming down. Investors buying those bonds, hoping to seek some safety from a rate hike-driven recession. Bitcoin, by the way, continuing to rise on optimism that big financial institutions are going to be able to kick off an ETF here. $31,161 is the price for Bitcoin. Oil, on the other hand, is down again. It is the worst week we've seen for oil since at least the beginning of May. It's off about 4.5% so far this week, and down firmly below $70 at $69 a barrel for West Texas Intermediate. John?
You've now got that S&P energy subgroup down about 11.5% on the year, Matt. Beyond the sort of broader story, we've got some individual sector movers we're watching. 3M at this point, a little bit weaker after some earlier gains, paying more than $10 billion over more than a decade to settle those forever chemicals claims. And we're also watching shares of Starbucks down about 2% right now, as we have seen that strike action at more than 150 locations tied to the Pride Decoration ban. We'll continue to track those stories. Virgin Galactic has been an interesting name to watch today. Obviously, we know about Richard Branson's space travel ambitions, but the company looking to raise some big cash for those efforts, and the dilution worries there weighing on those shares to the tune of about 15%. And a touch of weakness in Nike right now, Matt. Wells Fargo lowered its outlook for the company as we get ready for some earnings from the shoemaker as we head into next week.
All right, so let's take a look at what's going on right now with the stock market rally faltering. The trouble in property markets persists, and real estate has been a huge topic. This week, Fed Chair Jay Powell said the bank is watching commercial real estate closely.
It's really which banks have concentrations, high concentrations of real estate, and that is not seen in the large banks. It's seen in some of the smaller banks. So we've identified those banks, and there's a supervisory toolkit where we work with banks to try to help them resolve those issues by raising capital or dealing with what's happening. And of course, what is happening in the office space nationally? There's an issue with people working from home and just less demand. There's a sort of one-time adjustment going on. There are also some other pockets of commercial real estate where there's some softness. So we're working with banks to work our way through this. We're very aware and very focused on the problem.
And for today's Bloomberg Big Take, we're breaking down how higher interest rates are influencing property values, the commercial real estate market, and it is obviously a story that so many are interested in right now. Natalie Wong and John Gittleson co-authoring the Big Take and joining us with some more perspective. Thanks both for being here. And you heard those comments from Chair Powell. In your piece, John, I'll start with you. You dive into the numbers on how much commercial debt is coming due, how it's going to hit. What can you tell us about the numbers right now?
Big numbers. Depending on your source, the Mortgage Bankers Association says over the next 2 years, in the U.S. alone, $1.4 trillion of debt coming due. Much of that won't be a problem, but there's a lot of it that's office debt. And that will be harder to refinance because A, the cost of borrowing is up, and B, the value of those buildings are down. And so people are going to have to pay a lot of money or decide not worth it to refinance these places.
So are we starting to see transactions normalize, or any hint, Natalie, that that's going to happen? Because right now we're stuck in a kind of transactional stalemate, right? Sellers don't want to let go at much lower prices, and buyers are having to finance purchases at much higher interest rates.
Right. I mean, we've been stuck for quite some time now. Over the past few years, especially in the office sector, sellers and buyers just weren't agreeing on what price to sell at. But now we're at a tipping point, which John mentioned. There's $1.4 trillion of commercial real estate debt coming due in the next 18 months. And a lot of banks and lenders and owners have to decide exactly what to do and where values stand. But we're still at a point now where transactions haven't necessarily been at full force because some owners are going to have to take a big loss, some lenders are going to have to write down a big loss, and it's unclear exactly how much further down it'll come yet.
One of the interesting things to me, John, is that some incredibly asset-rich institutions with very wealthy investors are starting to simply walk away from, $100 million or billion-dollar properties, Blackstone, PIMCO, Brookfield. Are they really going to just default and leave, or are they trying to negotiate with lenders who probably have little other choice?
Well, I think there's a combination of two things. You're right. In some cases, it may be a negotiating tactic, but they're also just looking at the raw numbers. These people are, they can't wait forever to get their money back. And there was an article I wrote yesterday about how one analyst at Capital Economics says it will take until 2040 at least for office values to recover. So if I have property now, I'm not going to wait for another, 17 years to get my money back. I don't have that kind of time. So better now to cut my losses than keep pouring good money after bad.
And Natalie, final word over to you as we take a look at availability rates and San Francisco right up there. I mean, you guys look at markets around the country in your piece. Matt yesterday was talking about, big tech excitement in San Francisco, maybe the industry feeling excited right now, but the realities are in the property market, it is a complicated one.
It's extremely complicated. San Francisco has been the hardest hit in their office market because really tech led the remote work pullback. A lot of companies weren't coming back to the office right away. And then you have a confluence of factors with the downtown, people not feeling that safe, longer commute times to head there. And so you have a bunch of skyscrapers that are largely empty. Vacancy rates are at record heights and leading the way across the country. And then you have owners, major institutional owners, that are starting to default on loans for their skyscrapers in downtown San Francisco.
All right, Natalie, thanks so much for joining us. Natalie Wong and John Gittleson wrote today's Big Take story. You can check out the whole piece in the latest edition of Bloomberg Business Week as well. Pick up the magazine or type NI Big Take on your Bloomberg terminal. Let's discuss how this real estate situation impacts defaults and distressed debt. For that, we bring in Winnie Caesar, Global Head of Strategy at Credit Sites. And Winnie, I have a viewer writing in and asking, if the big boys are willing to hand over the keys to these properties rather than continue paying. What does this tell us about the macro view over the next 18 months?
Thank you so much for having me today. That's a great viewer question, and I think that the macro view is highly uncertain, especially in segments of the economy like office space and commercial real estate that have gone through a fundamental transformation in terms of how workers behave, how much time we spend in offices. I'm at home today, obviously, and I think that there's a lot of takeaways that we can bring into other parts of the economy, into the corporate bond market. But it's not, a universal bad or universal good. Instead, we're looking at this cycle as more of one where we have kind of a series of rolling challenges and headwinds that affect different sectors at different times.
And Winnie, walk us through at least some of the mechanics within the high yield market. Let's say there are those who are needing to tap that market right now. What's the process looking like? What are investors? What are the questions being asked? How's that all going to play out?
So in the high yield market, we saw basically an issuer strike last year. There were a lot of companies that had afforded themselves the luxury of time and the ability to wait out some of the market volatility and rise in borrowing costs because there was so much proactive activity in refinancing, pushing out maturities, raising liquidity, putting cash on balance sheets for a rainy day. Now we're getting to the point in the U.S. high yield market where companies are starting to see 2025 maturities, 2026 maturities, and say, if we want to maintain our investor credibility, we're probably going to need to start thinking about how we're going to address these sooner rather than later. And I would say that the market is generally open and receptive to a wide swath of companies. Now, when you get into the more storied or stressed companies, it's a very different issue, and you have a massive delta between existing borrowing costs and prospective borrowing costs because yields have risen so much, and investors are being much more circumspect in saying, is this an okay company and a really bad capital structure, in which case I'm not necessarily willing to kind of throw more money at the problem. And if it's truly just a bad company, bad capital structure for the current environment, then investors are just walking away, kind of like in commercial real estate.
All of a sudden, mortgage.
There's no real need to refinance, unlike in Europe or the United Kingdom, where you have more kind of resetting of mortgages on a fairly regular basis. But in terms of demand for new homes, the potential for mortgage rates being so high has definitely been something that people are concerned about. And I do think at this point we have some questions around the momentum of consumer discretionary spending when you have increased things like mortgage expense for anyone who might be kind of new to the home market. But we also are now seeing that rents are coming down a bit. And so that does have kind of a bit of a leading indicator in terms of what the inflation side of things on the housing side of things is, and then also the ability for the consumer to maintain its base levels of spending.
And then briefly, Winnie, just shifting from housing, in the stock market, we slice and dice different sectors, try to make assessments of risk tolerance right now. When it comes back to that issue of distressed or distressed debt, sector by sector, are there any themes emerging right now?
There are some themes emerging, and I would say that the types of themes that have emerged are actually very different from what we saw in much of the post-GFC era. In the 2014 to 2016 timeframe, we had a default cycle that was highly concentrated in energy and commodities. Then in COVID, we had a default cycle that was highly concentrated again in energy and also in retail. Now what we're seeing is the distressed composition of the market is much less concentrated in any one particular sector. There are definitely a few leaders, things like telecom, media, and healthcare, but it's a much more dispersed universe than it has been historically. We think that this is both good and bad. In the good, there's no one sector that may take down your portfolio, but the bad is credit selection really matters, security selection really matters, and sometimes it's really hard to get your arms around all of those moving pieces when there are so many different problems that the economy is currently facing. It feels a bit like a game of whack-a-mole.
All right, Winnie, thanks so much for joining us. Winnie Caesar there from Credit Sites talking to us about the real estate market. Coming up, Meta announcing it's going to shut down access to news on Facebook and Instagram in Canada. We'll tell you why next. This is Bloomberg.
Climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, only on Bloomberg TV and radio.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller, and want to talk about our stock of the hour. Matt, it's Meta today, making a lot of attention, getting headlines here in Canada after the Canadian government passed the Online News Act, part of a drive by Prime Minister Justin Trudeau's government to increase regulation of the tech industry. It requires digital platforms to pay local publishers for linking to their news stories. Meta responded by saying it will end the availability of news on Facebook and Instagram for all users in Canada. We're keeping an eye on shares of Meta as well today, which have been big performers so far this year, but tech is losing a little bit of steam. Right now, stock's actually up about 1%. Let's get some more perspective, though, on this development. Canada's crackdown on tech. Carmi Levy's a technology analyst with Written Incorporated, and he joins us now. Carmi, it's nice to have you with us. You know, it's interesting. There still seems to be this view that maybe Meta and the Canadian government will at some point sit down and talk. But this is now law, and Meta has been pretty clear that they're ready to walk away.
Yeah, they've made it very clear that if this law is enacted, they're basically taking their ball and going home. And the good news for those of us who have been watching this for a while is that there still is a bit of a window for everyone to back away from the precipice. The law has been passed. It's been accepted by the Senate. It now awaits royal assent, but it'll take a few months for the regulatory machinery to kind of work its way through, for the rules themselves of how it'll be implemented day to day to be finalized and for them to actually come into effect. So essentially what's happening now is it's a high stakes game of brinkmanship. Meta has basically said if it goes into law, if it's enacted the way it currently is worded, we're out of here. But there still is time, and discussions are still ongoing, both including Meta as well as Google, which is in a very similar position, that they could very well back away from the precipice if in fact those rules are a little bit more to their favor.
So the shares are up, as we just saw, and maybe analysts or investors think that Meta's bluffing here. It's a pretty big market to walk away from, right? As we were just writing earlier this week, more than 40 million people and climbing. Plus, these kind of laws are likely to be enacted around the world. How will they avoid it if, you know, the U.S. puts such a law in place? We've already seen these laws in European countries and in Australia.
If these laws don't happen for Meta, it's an absolute disaster for the company. Basically, they need this. Yes, they've been getting the content for free for years. They're not very happy that they have to pay for it now, and that's why they're swinging as heavily as they are. But the truth of the matter is this is an important method of discovering content for them. It's an important way of driving traffic to media platforms and of generating advertising revenue that Meta desperately needs as it pivots toward what it thinks is its metaverse and AI-based future. So, you know, you don't just walk away from an audience like this, and you don't just say no to that kind of revenue. And at the same time, if this happens, they devalue the very reason that people use their platforms in the first place. If I'm using Facebook and Instagram and I'm not getting my media content there, guess what? I'll spend less time on it. There's less time for me as a consumer and less opportunity for me to use that platform over time. That leads to audience disengagement.
By the way, Carmi, we seem to be pretty focused on Meta, which has alternative use cases. Google doesn't have any, as far as I can see. I mean, if I can't link to other news sources through Google, what would I use Google for at all?
Yeah, and of course, Google is under mortal threat from the emergence of AI-based tools, which are essentially targeting its core search-based advertising business. So, you know, if this falls under threat and Google doesn't figure out how to monetize media-based content, it's in an even bigger world of hurt than Meta would be if it decided to walk away. So these are companies that are essentially, you know, threatening the government with nuclear war, knowing full well they're going to get hit by an even bigger blowback than any government ever would be. Canadians and citizens in other countries will easily figure out other ways to get the content that they need, and they'll very happily leave the Metas and the Googles behind if they decide that they don't want to be part of the party.
There are some, though, very quickly before we let you go, Carmi, that are frustrated with the government pushing so aggressively with this. And then you mentioned AI. I mean, it is generally true that technology moves faster than legislation or new laws. And that whole AI wrinkle and how that's going to impact news is a whole other ball of wax.
It absolutely will, but the difference between sort of AI and earlier generations of technology like social media is the artificial intelligence community is actively calling on governments everywhere, in Canada, in the US, around the world, to legislate them. They recognize that the threats of unmitigated AI development are much more significant than anything they ever saw with social media. The potential for disruption of economic markets is much larger than they've ever seen, and they actually want those guardrails in place, which is unprecedented in the history of technology. I've never seen it in my career, and so that's definitely worth watching. And certainly Meta and Google are the two companies that have the most to lose if they don't figure it out and figure it out quickly.
I mean, let me just quickly ask you, Carmi, what do the publishers think? I mean, if you can't find news on Google or on Meta or these kind of platforms, do they think consumers are just going to go straight to, NYT.com or Bloomberg.com and find their news that way?
They're going to have to find alternative platforms, and I would expect they're working on their own marketing plans. They're working with aggregators and other alternative channels so that consumers can switch from one to the other. But there's always going to be a cadre, a strata of consumers who, aren't going to make the investment, aren't going to take the time, and unfortunately, they could be lost. We could see a significant impact to media platforms if they don't figure out how to transition off of that addiction to social media-based traffic as well.
What a fascinating story. Carmi, thanks so much for joining us. Technology analyst Carmi Levy talking to us about this Meta Google news story, really. Coming up, CarMax shares are surging in today's session. We'll tell you why. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Time for today's For What It's Worth. Matt, our number today, $1,600. That's the average price decline we saw per vehicle sold at CarMax in the latest quarter. That was a decline of about 5.5%. While used car prices had soared, higher interest rates are impacting demand. The used market also impacted by a rebound in the production of new vehicles. CarMax shares getting a lift today, Matt, but that's in part because they are lowering their costs to account for some of those lower prices.
Right, and trying to take some market share with that. Of course, consumers, we talk about the average mortgage rate at $3,000. Consumers are regularly looking at $1,000 car payments, and we're seeing default rates pick up as well. So it's a real concern and something to keep an eye on for this economy.
Absolutely. And for Matt Miller, I'm John Ehrlichman, and this is Bloomberg.